Welcome, everyone, and thank you for joining us this morning. We're going to go ahead and get started. My name is Biola Labi. We're here today to attend the Investor Readiness and Beyond the Pitch Deck session hosted by Innovator Trust. So I want to thank Innovator Trust for putting this together. We've been so excited to have people come from far and wide. We have people joining us from South Africa, from Nigeria, from the US, Mali, Kenya, Greece. And so this is a testament to the work that Innovator Trust does. Innovator Trust has been around since 2014, and their goal has always been to support and nurture the growth of entrepreneurs in the information and communications technology sector, with the goal to develop competent SMMEs who are sustainable and independent. Through their various programs, they offer enterprise development, supplier development, youth entrepreneurship, and startup incubation. The Innovator Trust have been able to provide coaching, training, infrastructure, and technical to support entrepreneurs eager to grow and in need of much needed boost. In doing so, the Innovator Trust has built a brand that remains true to the ethos of innovate, cultivate, and mentor. So I'm really, once again, excited to have all of you join us from far and wide, and really prioritizing this morning as a topic and a conversation that is important to all of us, but really important on the continent as we now have inflows of capital that we're all ready for investments and ready to grow our companies and ready to build the continent we want. Conversations to Innovate series is something that was started back in 2020 during COVID-19, when everyone was really locked down, and really trying to provide entrepreneurs with an avenue to engage with one another in the absence of not being able to meet physically, because entrepreneurs need support. Entrepreneurs need to have that opportunity to connect, to share, and to grow together. It's a journey you're on, and that destination sometimes is filled with a lot of ups and downs. And it's really important to have a community of other entrepreneurs that you can share things with. And so this is really where this has been the evolution of these conversations, and they've been some of them on IG live discussions and more formal webinar settings like this. In the past, we've covered topics as mental health for entrepreneurs, financial fitness, branding your business, and many more. And we've grown the network of entrepreneurs in our audience bit by bit. Together, we've all shared and learned from each other. We hope that today is no different for all of you. I'm joined also by Serena Davis, who will be going through the presentation. I will be moderating, and we'll be looking forward to really making this an interactive session, a learning session, and a growing session. So please make sure you follow Innovator Trust on Instagram, on Facebook, on Twitter, LinkedIn, and YouTube. Throughout the session, feel free to also share stories on your social media and tag us on your social media. So it's at Innovator Trust, and we're on Instagram, Facebook, Twitter, LinkedIn, and YouTube. I'll also put that in the chat right now so you can see that. But what I'll also like to do is, because we are building a community of entrepreneurs, for you to also share in the chat your LinkedIn so that we can also connect with each other. So please connect with each other, share your LinkedIn so that we can also take this conversation beyond today. A little bit about what's going to happen today. We're going to be going through the, it's an investors readiness program. And ideally what we are trying to do is go beyond the pitch deck. A lot of times when people see a pitch deck, people think that's the end of the work, but the work actually begins before your pitch deck and after your pitch deck. The pitch deck is really a tool in your arsenal. And so today we're really going to make sure that you're ready to go out there, engage with investors, but give you the tools to make sure that you're protected. And so who are we and how are we going to be doing this today? A couple of things, just a couple of ground rules. Please, we will be taking a couple of breaks because we know it is a long session, but really try to be back from the breaks. Breaks are going to be between 2 minutes and 5 minutes. Like I said, please share your information in the chat so that other people can connect with you. My name again is Biola Labi. I run a firm that is into backing entrepreneurs on the continent. we back entrepreneurs that we believe in, especially entrepreneurs working in the consumer technology space. We're a female-led fund, and we like to work with female entrepreneurs. But I want to go through today's program. Before we do that,
we're going to introduce ourselves a little bit more. Biola hasn't done herself justice, so we've got a couple slides on her because her background is really important in understanding her lens and how she looks at things. And then I'll give an introduction about myself in case you're not so familiar with me. We're going to break down the pitch deck and look at what makes it investor ready in the sense of how are we as investors looking at it and how are you going to make our lives easier. We're going to talk about the process before the term sheet, after you get the term sheet, what a term sheet is, and all the nomenclature in it, so all the vocabulary in it. And then we're going to go through mass samples because a lot of this, we're going to go through all the disasters that have happened just so that you're absolutely prepared, because nobody, when a marriage is going great, that's not ever the problem. So we're going to talk about when things are, what could possibly happen. So we're going to look at the math scenarios, and then internal preparation of your company. And then I'm hoping that we'll have a little bit more time because there's a couple of topics that we're passionate about that we added on to go through that. So I want to do a short introduction. I'm very, very proud to be here with Biola, who has Attica Ventures. And then I'll hand it over to you, Biola.
Thank you. So I mean, like, Serena and I are going to have fun today because we're just big fans of each other. We met during a VC accelerator program, which is people that write checks. And so as part of us understanding better the space and also how we can help entrepreneurs, and really one of the reasons that I really wanted to get into this was to demystify the process. There's a lot of mystique around it. There's not a lot of transparency. And so what we really bring to the table is that transparency. And you'll see that today in Sarita's presentation. She really does show you what you need to know to be investment ready, and also what you need to know to make sure that you build a sustainable and independent business on the continent, but at the same time, while reaching out to investors and getting investments. So a little bit about myself. I've lived and worked in many places. I grew up in the US and Nigeria. And then after that, we went back to the US. That's when I went to school. I started my career in the US. Working at companies like bigwords.com, which is one of the early e-commerce companies. It was an online textbook company that built up and raised over $100 million from venture capital. We were in the process of raising our Series B round when the dot-com bubble bursted in the US. At that time, before the burst, we actually had an offer from Amazon at the time, but Amazon was also a small company, and the founder really was his plan was to grow big, and that didn't happen when the dot-com burst happened. So this is really also an interesting experience for me very early on really when to understand when to sell and when not to sell, and really understanding the market you're in and not reading the market, wrongly. And that's sometimes very difficult to do. Right before the burst in the US, people saw it coming, but they didn't see it coming, just as the same time with the slowdown that we're currently experiencing. I also, because I had lived in Seoul and I had developed a lot of relationships, and one of the places I worked at when I was in Korea was Daewoo. When Daewoo was launching their new line of cars in the US, I was part of that marketing team that actually looked at the route to market, who should be the customer, how to identify the customer, and what type of programs to launch in a car market that is already overcrowded. American car market is crowded, but there wasn't a lot of room for first-time car buyers, and that became our target audience. From there, I was very fortunate to work in the US at a company called Sesame Street that does international co-productions. In South Africa, we have a show called Takalani Sesame. I put that here, but really they'd have this in 130 countries. And I was very fortunate to work on some of the Southeast Asia and Africa projects. And that led me to DSTV MultiChoice, where I worked on Mnet. I worked on launching our Africa Magic brands and really turning African content into global content. From Africa Magic came Mzansi Magic, came Wetu Magic, and Aqua Magic today. So I'm very proud of that legacy. And that led me to a telco in which what we were trying to do at Econet, which is a Southern African telco, was really try to think about the future of what a telco would become. And a telco would become a digital and technology company. And so we really started to look at investing in small businesses that were in the technology space. We started looking at media, how to integrate media into the business. And we also started to look at e-commerce businesses. And so I did that and really enjoyed that time, my time there, before I went out and set up my own consulting company, doing media consulting and then doing some productions. And a couple of my productions are currently on Netflix and will be on other global platforms soon. So that's sort of a little bit about me. But on this journey, I started meeting entrepreneurs like yourself. I became an entrepreneur. And I think when I became an entrepreneur, my lens changed because I really saw how difficult it was to raise funding. And that's when I started becoming an angel investor. And so this is a snapshot of the investments I've done. I've done over 30 angel investments to date. People always ask me what size checks. I mean, these investments all range between $5,000 and some of them all the way up to $50,000, depending on what stage you are in your company. Sometimes it's an idea and I really believe in an entrepreneur and I really want to support them and I come on board. But really for me, like the Innovator Trust does, I really believe in mentoring. I believe in working and nurturing these talents from the beginning so that we can actually build sustainable businesses. So this has been a mission-aligned process, and I'm really excited to be here. Serena, back to you, and thank you for that introduction. Thank you.
So I have to brag about Biola a little bit more because even though you're saying you write checks of 5,000 to 50,000, you've syndicated in some of the angel networks that you belong to much larger amounts.
Yes,
in fact, where you were the lead angel investor, I think you've done up to 250 or even more. So when you approach Biola as an angel investor and she's, it's 5,000 with a room full of much more. And that's kind of part of the angel investing. Now, this is not an angel investing presentation, but it's still about investor readiness. And the angel investors are usually successful people, so they're gonna look at this very much the same. And the other thing I want to say about Biola that she didn't mention was that she has managed, which is very important. I've been a part of many growing ecosystems. There's often a disconnect between the government understanding because they're very busy with many things. I don't like criticizing governments too much in the sense of I can't imagine what it'd be like having to be an expert of, trash cans as well as running water as well as international politics as well. There's a lot on their plate, and so they need people like Biola around to kind of put information in their ear, because one wrong tax policy and you can drive away investment or you can bring it to you, and you have to do it in a way that really sort of benefits the local ecosystem as well. So you can't just listen to outside of the country. And so Biola has this unique sort of in the country and out of the country and being able to understand investors there. I hope I haven't embarrassed you, but I think it's very, very important.
No, thank you. I mean, I always tell people, yes, it might be a small, we have what we call Mickey Mouse checks, but we do end up bringing a lot of people on board that can also write those checks. And there are angels that really want to guide you and help you grow. But once again, we can have that session later. But thank you so much, Sarita. A little bit, not too much.
Okay, so I'm one of two GPs at Hippo Seeds in Greece. We say we're backing founders with the courage to solve difficult problems. I won't get into that because that's not about today. I have a very unusual background. So a long time ago, I made a presentation because everybody asks who I am, where do I come from? And I like to say that I come from the same place that everybody does, which is their mom's belly. That's my mama. Isn't she so cute? But geographically, I was born in Bonn, Germany, and I'm just going to take you through my geography really quick and then sprinkle in there sort of the experience that I got, because traveling and having contact with other thinking really shapes you. And Biola and I are both what's called third culture kids, which means that when you're, at your development stages, you are both inside your own culture and also outside of that culture, and it kind of shapes the way you're able to adapt and look at things, and be open to new possibilities, because you understand that from a young age, there are things that you haven't seen, right? Because you just kind of get on a plane and get dropped somewhere completely new. So I was born in Bonn, Germany. Yes, I grew up with bilingual. And then I moved to Kansas City, and then I moved to Missouri. And then I moved back to Germany, Heidelberg, and then to Washington State, Virginia, Washington, DC, back to Germany, Munich, and then to Texas, where I say that I learned yet another foreign language. And then from there, my senior year, I moved to South Korea. And the importance of this, I moved there, I lived in Pyeongtaek, I went to school in Seoul, but the student revolution was going on. So very peaceful, but a lot of tear gas. So that was very interesting. Also in looking at people, cry for democracy, cry for, and it was coming from young people. And that was a big impression for me at that age, about how much influence young people have without even knowing it. Then back to Texas, I started studying mechanical engineering and did programming. In the US, we pay for our own school. I thought it was just going to be a nice little hobby, programming, but it turned out that you can make quite a career from that. I did not continue in that, though. I went on to study economics, both in the UK, where it's very focused sort of on government, but then in Germany, where it sits in the philosophy department. And this really shaped me a lot, because there they were asking you questions constantly about, why are you doing things? What kind of society do you want? How do you want things to be? And so this was the beginning of sort of the how and the what and the why, and sort of this living system lens about consequences on certain things. I then went back to Texas, where I started in venture capital, first fund, 50 million. It was run by, at the time I was 24, so the guy was 36. I thought he was terribly old, but now I realized that it wasn't. And he had 3 exits. He's the one who got me into venture capital and how to look at things. Back then in the beginning, VC was always run by entrepreneurs. I'm a strong advocate of that. Especially in the early stages, and how to look at creating a company from a 20-page business plan. From there, I went on to the Netherlands, and I worked at 3 companies, 3 telcos that all got acquired. It was a mad dash at that time, 7 years, 3 exits. It was a very good learning curve. I then came to Greece, just basically to take kind of a small break, but then I ended up getting recruited by a Norwegian venture capital company that wanted to work in this region in the Balkans and also in Africa. And by then I had already traveled several times to the continent and was just absolutely enthusiastic and knew the endless possibilities that were there. I finally got a chance to live and work in 2010 in Kenya. Also for telecom, we raised $60 million in 2010. So this, where people were still getting on board about the possibilities of Africa. I mean, we knew the ones, everybody living there knows. I am back in Greece. This is where I have my hub. I love it here. Of course, I travel and do projects everywhere. So just kind of a summary, a visual summary of where I've been. I hope I haven't talked too long about that, but it's just to give you an idea of the lens and how I look at things. Of course, I've done angel investing and things like this. So here, I think we want to do a quick poll for questions. Biola?
Yes, just before we do that, I do want to do some housekeeping. Please put your LinkedIn in the chat. And let's keep the Q&As for Q&A, please, 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 just so that we really make sure that we hit all your questions. If there are LinkedIn or introductions in the Q&A, it gets really crowded. And then also it's just difficult to answer your questions. And some of the answers I will be typing in. So some of them I will be asking out loud. And some of them I will ask you, since your name is, if you don't mind actually either clarifying or reading your questions, depending on how much time we have. But please, in the chat, put your LinkedIn. I already see some LinkedIns in there. I'm already connecting with those people. I've also put my own LinkedIn in there. Please, let's do that. I'll also put Serena's LinkedIn there so that we can all connect with each other. And then let's leave the Q&A for just questions and answers. Yes, we will do a poll really quickly. And the idea there is to get a sense of where you are, and then and just understanding about investment. So if we can launch the poll now. Everyone, if you can just click, it's a real quick one. We just sort of want to get a pre registration on where you are in your journey.
And we want to keep you awake. So
yes, we will be asking you to do different things. We will also be giving you some leg stretch breaks. And during your leg stretch, we do ask that you do actually stretch your legs, because this is, part of also understanding and learning is also making sure that you get really good blood flow. So I will be looking. So please.
And the other approach I like that Biola uses is that we're not going to ask if you understand, if you don't understand. We're not going to be waiting for that. We want thumbs up at certain points. We're going to be asking for you to give a thumbs up, and I'll keep repeating until we get enough thumbs up that I feel 60–70% of the people are with and are following along, because I'm going to do some pretty heavy math at some point, but we're going to take it step by step. We're going to take everything step by step. And I may oversimplify things at some point, but it's just, first of all, this is how I think in very simple terms. I try to break everything down into its simplest core elements, and then build up from that. And then things, once you start very simple and you add another layer on top, at the end, what was originally complex then becomes very, very easy. So while we're waiting for this poll, or do we have the results? Do we have enough answers for results?
Yes, I think we can go ahead and start.
Okay, so what were the answers for the poll, or are we going to talk about it later?
The poll, do you feel ready to raise capital? The majority was that they feel very ready with 63%, not ready 25%, and haven't thought about it at all at 12%.
Okay, so this is good. This means you're ready to learn about engaging with an investor. I like that. Okay, gives me a good understanding about background. Okay, so there are three. Yes, there are three broad investment stages. The startup pre-seed stage is usually 50K to $1 million. A lot of it's self-funding. You get it from Angel. The pre-seed is about 500K to 5 million. Then you have what's called a growth stage. Here you've got series. What you hear is series A, B.
Serena, sorry to interject. Would it be possible for you to just go to full screen with your presentation?
What are you seeing now?
We are seeing two screens, or basically the two slides next to each other with the little slides at the bottom.
Okay.
Yes, perfect. Thank you.
This is where, okay. Thanks for that heads up. No, I think my share screen is wrong now, or is it okay?
I think I think I'm not seeing your share screen anymore.
All right,
no, I'm also not seeing it anymore.
Okay, let me reshare. I think with the poll, I had to change something. Apologize for this, everybody.
There.
Perfect.
Just going to full screen. There.
Okay, and so on the correct, you see just the one slide?
Yes.
Okay, all right, thanks.
Thank you, everyone.
So then growth stage is usually the amount 5 to 25 million. This can be called Series A and B. It can be called Series C and D even. It has to do with the amount. The late stage is over 20 million. So like we had in Kenya, the 60 million. And really the difference between these stages has to do with where you're at in the product cycle and the size of the company. So that determines, because investors are giving you the money to achieve certain things. Now, you can get an exit at any time. It's not that this is actually linear. And Biola has an example of this. I'd like her to share. You had an exit. Yeah.
Yes. So, I mean, one of the things we were talking about when we were going through this presentation was, if you look at actually, last year there was $5.2 billion dollars worth of investments that came into Africa. Most of that is actually in the growth and late stage, because people really want their investments to be just de-risked. So if you look at where you are in the early stage, of that 5.2 billion, 17 million of that was actually in early stage. And so we were really talking about just how quickly also exits are happening now. One of the companies that we invested in late last year, I mean, literally, it's like 7 months, they've gone on to raise couple of more early stage investments after our investment. And so they're now at like 4 times money back, which means they've 4x'd. And they now have an offer on the table to be acquired. But this is a really early stage company. They have a huge roadmap ahead. And so the conversation now is around, should they consider this seriously? Because the person offering could end up also creating the tools that they're doing. So, right, there's a sense that I'm acquiring because I don't want to go create this, but if you don't sell, I will create this. And because I'm a bigger fish, I then might actually outmaneuver you. So it's the same thing about when Facebook acquired WhatsApp. Facebook wanted to sort of get ahead of the messaging market, and they could build it, which they did. I mean, when they've gone ahead and built things in different phases. When people have turned down acquisitions, and so from an investor also, they had to have a conversation with us as investors that they have gotten an offer, and then we also have to help them with analyzing if this is the time we want to sell or not. With that particular investment is actually, we're still having those conversations, but different investors are really trying to make a decision if this is the right time or not, because what you don't want to do is exit too late and you're no longer relevant. So, and this can happen. I mean, this is so early as well in our journey that we're all wondering how to handle this. So I'm glad to share that. Thank you.
So this story is important too, because we want to talk a little bit about how a VC is set up. So a venture capital, and investors, a little different than angel, is that you're raising money from other people. And so you have a fiduciary of financial responsibility to them. And so the way a VC raises its fund, and this is why it's important for you to understand what's motivating them. The life cycle is 10 years. So the way that a VC will behave in year 1, where they have a lot of time on their hands, and the way they're going to behave around year 7 or 8 or 9 is very, very different. There's usually 2 windows in VC. The first years are about, let's say, deal hunting and investing, and then the rest is about these exits. So it's a 10-year, anytime a VC invests in you, it's a marriage. And it's easier to get out of a marriage. So when we get into term sheets and terms like this, it's very important in this relationship that Biola just spoke about. If you have an adversarial relationship, then the investors could be heading with a different agenda than the rest of the team. So it's, investor relations and understanding where they're coming from and building this relationship is just, it's very important. And what we're talking about today is early stage, as we've already said. The expectation is that you have your first adopters, you have your business model validation, or that you have to pivot, you have some sales channel, your use of funds are very important, to grow out the product, to really be on top of that, probably also IP protection, team expansion, these types of things, but we'll get into that much more very soon. So I want to take you through now 2 presentations. This is the one that you know very well, Arab Bed and Breakfast, as it was first called. This is the original presentation that they raised their first 500,000 on. This is publicly available. It's very famous. They went to 4 investors for 120,000, which in the US is angel, and were told no. So imagine, okay. And then they got in the room with somebody who gets it. You need to find a VC in the early stages who gets what you want to do. That's so, so, so important. So I want to go through this from an investor perspective. I'm not going to talk about, there's so many things that are being done on pitch decks. You know how to do a pitch deck, 10 to 12 slides. But I want to talk about how we look at it. When we see this pitch deck as an investor, what can make our life easier? The biggest thing is VCs, we have time. I mean, the sense of urgency is the highest on your side. And so today, what we're going to do is go through and say, okay, if you do these kind of things, it's going to make on the side of the investor, their due diligence, what's called due diligence, much, much, much faster, because you always need money now. So this is Airbnb, the problem, very straightforward. The solution, very straightforward. The market validation. So this is where you talk, if you don't have enough traction yourself, you can talk about other people who have traction, who are proving that this kind of product, that there's an appetite in the market for the product. Now, if you don't have that, you need to really then, it makes it more difficult, but you really need to find someone who's going to evangelize for you. But you really early on need to run pilot projects to show that, in fact, the product itself. So the idea of somebody opening their house, because Airbnb at the time was about sharing part of your house. It is turned now into, of course, renting the entire location. But if you don't have the right person in the room, in the beginning, this was considered crazy. So the market size here, you'll notice, and it's not very clear, but it doesn't matter. The sources are listed on the side. And if you can make this hyperlink and you can make it easy for these types of information to be found by the investor, the last thing you really want is for them to be Googling this type of information. You have no idea the sources that they're looking at. So put the sources there. We'll talk about digital data rooms a little bit later, but have all the information that you're using that creates these assumptions for you available for them to look at. Don't make them hunt around for it. So here we look at the product, just a quick little visual of it. If you, of course, if you can make it easy for them to somehow test the product, it should be done. And that doesn't mean, oh, we're on Google Play. That means putting in a link or sending them a link or anything that will make it easier. Here's the business model. Very straightforward, right? Just try to make it as simple as possible. This is their, they call it adoption strategy. It's often also known as the go-to-market model. So this tells basically what this signals to the investors, we have a plan for sales, because they need to know, okay, how are you going to get this out there? So this is important. Now, competition, this slide is growing and growing and growing in importance. I'm going to let Viola weigh in again on this. But if you say you don't have any competition, then we don't really believe you. I'm going to be so bold as to speak for both of us on this for briefly, because people are doing something now to solve a problem. If you have a really important problem that you're solving, somebody is solving it somehow now. And maybe it's not a formal company, maybe it's somehow informal, but as an investor, I think, okay, if for you to really understand the problem and the pain of your customer, you must know what they're doing now at the moment. And this becomes your competition. And whether or not you're sort of formalizing a chaotic environment and making it easier, that then is also your competitive advantage. That we get into. And Viola, I'd like for you to weigh in here, because I know how you feel about this competition slide.
Yes, increasingly, you're really, for us, we're trying to understand the competition. And sometimes I think people think that because if they're a pioneer, that always makes it better. Actually, it's not always better to be the pioneer. So it's always great to see that there are people in the space but you're offering customers something different. And I always used to tell people this, that as someone that was in launching television channels, anytime someone is not in front of their TV watching, that is competition. So if you go out to a restaurant, any other form of entertainment is a competition to Netflix or to a broadcaster. Those are their competitions. And so sometimes you'll see people trying to make their competition into a complementary. Yesterday, I saw that the NBA and Kentucky Fried Chicken have a partnership now. So I guess they sort of want you to be watching the game while you're eating. I'm not sure I understand that, but that is obviously, they felt like that should be, they should turn that competition into a complementary relationship. And so when people don't have competition, or when people don't really understand their competitors, it really concerns me. And so this for VCs is always a red flag if you're not really upfront and honest about who we should be thinking about as your competitor. There could be a lot, I mean, there could be so many people doing genotype, but really the understanding is, what are you bringing different? What is different? How are you disrupting this space? And is there enough space? Because healthcare is another space that is big enough for so many different players. And so we want to understand, okay, how are you doubling down? And what are you doing? And are you doing it very well? So don't be afraid to show your competition and share who your competitors are.
And if you are being a really bold pioneer, then your sort of go-to-market model, so your customer onboarding becomes more important. So if I get it as an investor, that's great. I've had that of angel investors in Kenya, often in female entrepreneurs, because they're facing male angel investors and male investor VC who don't really get it because they're not female. And so I love that on the continent, faster than in Europe, actually, you're getting female angel investors and female VCs. So it's important how you pick your VC as well, because you want what's called a champion who gets what you're doing. So we talked about the team slide. I won't get into that too much here because I'm going to talk about later on, but you see at the bottom here, is their advisors. Sometimes people put this more prominent. I think that I'm investing in the team. The advisor you have can open doors, but they're not working every day. Even the most devoted advisor can't offer full time. So then they put in some press and some user testimonials. Now this slide I like very much because it's financial. It's also the ask. So they're saying, we're looking for 12 months financing. So that 500K, the slide is very simple, right? You realize I want 500K. How long is it going to last? It's going to last 12 months. What am I going to get for that 500K? I'm going to get 2 million in revenue. So, immediately you're like, okay, that's good. That's pretty clear. Do you want to add anything, Viola, or should I go on?
No. This is so exciting for an angel investor to see or a VC to see, because it's very clear what's going to happen over the next 12 months. And so now we have a clear indication of what is the metric that we need to be communicated, that we need to have our communications based on. So we don't sort of need to go on and on about everything else you're doing. This is really what you're reporting on a regular basis when you're doing your reports to your investor. So the investor has already honed in on the next question, which is the how of how you're going to do this. They don't sort of have to have all these other questions for you about marketing, about all the stuff. It's really like, it's about this and this alone. And then you explain everything else around it. And I think this is sometimes where people get tripped up. They don't really tell you how long the money that they're raising is going to last. So if you also as an investor are not going to be in a position where you can do a follow-on to that investment, you need to know upfront, because it helps you understand how you're going to negotiate from the beginning. So if someone comes and says, oh, we don't know how long this is going to last us, you're mentally just sort of tuning out once again. And once you start, you're doing these mental tune outs, and then at the end, you're trying to see, is there enough here to continue this conversation? And so what you want to do is always capture your investor from a understanding where you're going, because it's that roadmap, it's that destination that people want to see that you have clarity on. Thank you.
So the next startup is Mazi Mobility. It's a Kenyan one. I mean, obviously, I'm partial to East Africa because I've lived there. The founder of Mazi Mobility, Jesse Forrester, I spend a lot of time on pitch events and any events where I can get to know entrepreneurs. And it was the way that he spoke about managing his employees that really grabbed me. And I'll tell you why. Right now, I mean, everything's booming. Working in a startup shouldn't be on the job training. I know as an investor that the more mature the team is, the more cash efficiency, the more able they are going to be to pivot. And the way that he talks about with such respect about employees and how they were so equal in how he looked at this company, I knew this is the guy, he's going to be able to recruit away from large companies really good talent. And that is something that's really important, because in early stage, it's a lot about the people. It's absolutely about the product, and it's a lot about the people. And so he really, really impressed me. And I reached out to him, it's been about 2 years ago now. And he jumped over the small amounts. He went straight for first fundraising of 2 million, which he, I think last week or the week before, he successfully closed. His pitch deck is incredibly impressive. I wanted to show it to you now and share with you slide by slide. Don't worry, I won't spend too much time on it, but I just want to talk about the really, really good things on it, from how he's engaging the investor, okay, not the marketing, the pitch deck stuff. Now, what I've done is I've kept the frame, you see Dropbox, because he's done everything in digital data room. He had one of the most mature digital data rooms I've ever seen. And I'll get into that later, how you set one up and the importance of it. But so we'll go through this. It's the slides, you know, the clear problem statement. And here is the solution. Now, if you read the solution, it sounds a little bit vague. And what happens often on the continent is you have a particular product, but the maturity around it, you need enablers of your product. When I first arrived in Kenya, it was like, bring your own infrastructure. Sometimes you're trying to build a product, but there isn't a road to get there. And so for a temporary amount of time, you're gonna also have to help build the road, even that isn't core to you. So what he's doing is, that's why he keeps the solution kind of vague, and you'll see what the actual business is. So it gets into, you know, electric motorbikes. We know that we can't keep living the way that we're doing. He's, you know, early ahead electric motorbikes, but this isn't really what he wants to sell, but he has to right now in order to get into the market. What he's selling is battery as a service, because especially for little motorbikes, you've got to be able to swap out the battery. You can't sit somewhere, especially if you're a delivery guy, and wait for the battery to recharge. So he has this intelligent AI network about battery swapping. And so that's actually where he wants to get to and where he wants to expand. And it becomes then a software play, but you can't start that way, right? So he has to build all the rest of this infrastructure. And so, okay, here's the market. Very robust competitive overview. You know, talking about the unique selling points. So why is he different than the other guys? A clear roadmap. So this explains then where he's been, and again about the money, where it's going to take you. Now here on his financials, what's interesting is he's really what he was saying before is, I'm battery as a service. So dark blue, I'm battery as a service, but I'm having to do BOTA sales, you know, motorbike sales, in order to get the market to mature. And he shows in his vision then how over time, this is going to, you know, the sales are going to be pushed more in towards that battery as a service. And my personal interest in him is that I would like to bring his AI to Europe, because I think a lot of things match the continent to the Mediterranean, because we also live in a very chaotic environment as well. So that's what I wanted to show. And so, you know, he has the team, okay. And then what he decided to do was, here's his funding. It's not very detailed, but it does talk about how he's going to raise. So this is a little bit different. What he does then is has an appendix. Now, the way I usually, if I sit down and I see 23 slides, I'm already like kind of half like, no way. But what he's done is that he's made the first slide so compelling that I actually ended up going through all the rest. So you know, don't overdo things in the beginning. Make an appendix, make it accessible, and it reads like a story. And Viola's background is very good. She's in media, she's in storytelling, right? So if you're telling the story well as you go along, somebody's going to want to get to the next chapter or the next episode, which she's done in these appendix, which is, okay, who's my customer really, some text specifics, and other information like that. So this is, you know, this is why I love this presentation very much. So now on market size overview, we get into numbers here again, have the sources easily available. Now in his rich digital data room, what he's done is he's had folders, and all of the data that pertains to this market size is there. So you don't even have to go on the internet, but of course you will, as an investor, kind of make sure.
But we do have some questions, so I'll go ahead and read them out just so we do that before we move on. The first question is, what type of returns are VC and angel investors looking for when considering an investment? And then the other question was around just going a little bit more into the data room concept. So we tell people just a little bit about what the data room is. And how do you break down and communicate the urgency of funding into realistic milestones? So just quickly to start, one of the things that we, you know, when a VC goes out to raise money, different VCs have different numbers that they've promised their investors. And remember, once again, investors are looking for a return on their investment. So every market is different. Right now with startups, people sort of know that 50% of them are not going to work. So if we invest in 20 companies, we know that 10 of them is not going to happen. 3 of them are probably going to have an exciting, what we call an exciting exit, which is either they're going to IPO or they're going to have a great acquisition. And then there are about a few in the middle that sort of will give you about 3 times money back. And when we say exciting, that is 10 to 20 times money back. Those are some of that's what they're looking. I mean, and everybody wants to get a hit from day one. So when people are looking at your company, they're going to look at it from a lens of what type of return on investment is realistic for this company. And so a VC that is, once again, depending on where they are in their phase, if they're early on and they're in a place where they can actually develop, they can coach, they really have a long runway with the company, they can say, look, we can see this company growing into $100 million company. And that would give us, if we do 2 rounds of investment in this, that would give us a 10 to 15 return on our investment. We want to go on this journey with you. But if someone is really at a place in their fund cycle where they're towards the end of their fund cycle, they're going to be looking at more mature investments. And those at that time might only be, they've been de-risked, they've had Series A, they've had Series B, and they're maybe just being primed for an acquisition. And at that point, you can see people thinking, okay, if I get a 3 times money back based on where we are in the cycle, we've already had a couple of outsized returns, we're happy with that. So it does vary depending on the stage you're in, the type of company, but you can always think that from the beginning, people are looking at, is this the type of company that we can get a 10x return on? That's sort of always the question. That's the internal dialogue. And sometimes that answer is yes, sometimes it's no. And then the VC will still make the investment based on the opportunity ahead. Angel investors are very different because angel investors are much more about, they're much more about return and impact and really trying to disrupt. So angel investors are usually people that have seen a problem, they can the problem resonates with them, and they believe that they can get you to a place where you can actually have an outsized win. And so it's really also important to have the right angels in the room when you're raising. I'll let Serena add to that.
So regarding the other 2 questions about the digital data room and the milestones, I get into that quite some detail at the end. In the last section. So I'm gonna not answer those questions, but to round out Viola's comments about investment, focusing on the early stage, it's really, you know, everything. I agree with everything. In the early stage, a lot of it is going to be, you know, whether they think it's possible. Now, what I do want to encourage you as entrepreneurs, don't look at where money is being invested right now, particularly on the continent, as a statement of where growth actually is, because there's a lot of movement towards fintech and software and things like that. And from an investor perspective, they feel that this is lower risk. We know right now the growing middle class, all the opportunities. It's insane to be importing potato chips when potatoes are grown, and so I'm really a strong believer that, all ships are rising. And so if, for example, I know there's a woman in South Africa who's, she's making her own soda, this is something I would believe in very much. If you look at obviously you look at due diligence, but as far as the space itself, I completely and totally believe in it. So, there's high net worth individuals at Coca-Cola or somewhere else at these Westerns that are the CEO of South Africa, and these may be the people who would end up investing in you. So when you're hunting angels and when you're hunting that first 250,000, take a look at where you think you may find these people. That's just an aside that comes out of the, from the question. Okay, so getting back now to
so just one more thing. Sorry, there was a question around what are some of the things in the back of the VC mind. One of them is team, which we go into pretty detailed, and really the way you think as a founder. So this is really about the team you're building. One of the things that Serena said about the Mazi Mobility founder was the way he was thinking about building his team. And so the first thing an investor is looking at is, can this team get from point A to B and B to C? And so you'll see that there's a lot of time spent on really understanding the team, understanding what different people do on the team. And so if you're a solo founder, you really need to make sure that you have people on your team that really people see as your equal, that people see that you're all making a contribution, and that you have also compensated them from a shareholding perspective so that they have skin in the game. These are all the things that are important, but everyone will always tell you it is really about the people doing this. It's a people business. Every business is about people, and we need to see that you have the right people, you're thinking of the people in the right way. And you'll see when Serena goes through the org chart, thinking about when you're bringing on different people as well. So please, people, I think I had a quick finger and deleted that question, so apologies for that, but I wanted us to get to that before, since I accidentally pressed done and something else.
Okay. So
too many open things, but yes, so sorry about that, guys.
Yeah, I bet it's a bit Star Trek command. So yes, we'll get into it more. If you're a solo founder, though, I don't want you to be disheartened. A 23-year-old here in Greece raised 400,000. 23-year-old female raised 400,000. She was a solo founder. She understood her business so well, and she had suppliers and very good relationships. In the due diligence we did, we checked on the relationships. So she had an outsourced programming group, and she had other things outsourced, but she had such great contracts and she had such good working relationships that when we did on-site due diligence, it was a non-issue that she was a solo founder. So it's, it's how you build a team, and a team can be internal and external. It can be internal. And of course, part of that 400,000 ask was to start bringing inside those skills that were represented by suppliers, but she got there, so it's how you're thinking about your growth. It's not where you're starting from, it's how you're thinking.
Thank you. And we also have another question, just because I do want to get rid of these questions because I know more will come. There's a question about the mobility pitch deck, if they could have access to that. I don't know if you have permission to share that.
I have permission to present it, but Jesse, no, I can't send it around.
Okay. So unfortunately, we can't share that, but it is, this presentation is available on YouTube, and you can watch it again and again. Vicky has a question, which is, what if Airbnb didn't reach their target, the one shown in the funding deck? That happens a lot. One of the biggest and most important things is communication. You have said that this is what's going to happen in 12 months, which means that you have 12 months to continue to communicate with your investors to say, this is what happened this month. This is what didn't happen. And even sometimes, I mean, depending on the type of investors, especially with a business like this, you will have ample time to continue to communicate to people. And people know that you're going to run into roadblocks, things are going to happen, regulation is going to change. Investors know that things and environments are going to change. But the worst thing you can do is not communicate when you hit those roadblocks or when you're in trouble. This is where founders really falter. So please continue to do those reports. Sometimes they might have to be bi-weekly, especially if there's a lot of asks that you have from your investors and you need investors to help you. And at some point you'll have some relationships with investors that would be really, I mean, sort of almost on a daily basis. I've had to do some crisis management for founders, and literally we were talking every evening for a whole full week to get through that. So communication and making sure investors know what's happening. And making sure that you guys really did try to hit those targets. I think that's what's important to an investor. Not that you're going to do exactly what you said on this day, on that day, but the fact that the journey and they've been carried along, that's important.
So in the early stage, your investor, and I've been in markets where they don't do this well because the profile of the investor, but they shouldn't be police. Early stage, they need to be a partner with you. You need to know your investors. When I was in VC in the US, it was so competitive that, you know, it didn't matter the money you had to invest. It had to do like, oh, I want that. Y Combinator is quite famous. You want to be incubated by them. Why? Because it's the value of what they do. And as the VC market, which I look forward to, gets more competitive, then the VCs also have to provide services beyond just the cash. So the communication is really, really important. If you go in the relationship and you see them as police, then you're starting off kind of wrong already. The communication and building a relationship. So the reason Biola was being called every day was because this guy felt she could help and they were going to solve a problem. I always say, and I've been a senior manager in large companies, is that if you drown and you don't tell me, it's your fault. But if you drown and you tell me, then it's our fault.
Yep.
We've got to do it together. And then a lot of it is about thinking, right? So call up with the problem and a potential of 2 or 3 solutions, and we can talk through those, and we will get it on track. But don't surprise me. Before I get the report saying we didn't meet the targets this month, well, monthly or this quarter, I should kind of have already known that. And you should know why you're not hitting them. There was a tsunami, there was a supply chain, man, but what are we going to do? And then therefore what? So it's not, when you put up a number, it's also about what does that number mean? How did it happen? What is it an indicator of? Do we need to pivot, or is it supply chain, or is it, seasonality, anything like this? It needs to be a number that you've thought about. Okay. So, what is due diligence? We're starting to get into the meat of things here now. Simply put, it's an accuracy check. I actually say it's an integrity check, because, somebody's giving you their money. They don't want to have to be there every day. They want to know that you're a subject matter expert in what you're doing, or that you know what you don't know. That's often the thing. And you know how to find the answers. What was so impressive about this woman, this 24-year-old woman in Greece, was that she had no ego about not knowing something, and she was absolutely determined to find the answer, and she knew she was going to find the answer. So this is, having to know everything is less important than knowing what you don't know and knowing how to get it. And those are the kind of things that will come across as you dive into the due diligence. And it's not about being insecure. It's, again, you can be confident about knowing how to find answers and how to do it in a timely way. So, so the process at a high level is, okay, so after the pitch deck, right, they're engaging with you, the price, there's a pre-term sheet due diligence process, okay? Then you're gonna start negotiating. You will have discussions about the assumptions of the business plan. They're going to ask you certain things. They may have experience. We did an investment when I was at Olympia Holding of $1 million. And when I looked through the business plan and the assumptions, they had a 3-month assumption about a sales window. My experience, they were selling to telecoms. And my 10 years working in telecoms, I knew that this was going to be actually 6 to 9 months, which dramatically changes your revenue process and the business plan. So you're going to have a lot of discussions around this. Because this is the foundation for which you sign together about that create those targets we just talked about once the investment is there. So this is going to be a lot of discussion around that. Then they're going to offer you a term sheet. And then after the term sheet, there is again post-term sheet due diligence. And what's the difference? I get into a very extensive list at the end of what you should share when, okay? Because you should never, ever, ever give away your cookie recipe, but you do need to share information, and it gets more and more, sensitive information should be of course protected, and you need to decide when to give it. So I'm going to tell you when you should give what. Now, what is the significance of a term sheet? Okay, what does that mean? You get to the point of a term sheet, what does it mean? It's ethically binding to both parties. Now, it's not legally binding, but it's so ethically binding that if a VC backs out after a term sheet is given, obviously, if they go into deeper due diligence and they find that you're lying, then obviously they have the right to back away. But if you have, everything that you say, all the information you've shared is correct, you've agreed to the term sheet on certain business assumptions, if they back out at that time, it can kill them in the marketplace. It's extremely ethically binding, okay? And it agrees high level to the investment terms, your valuation, voting preferences. I'll get into a term sheet and all those items, so don't worry about that. But it's important to understand the significance of it once you get to it, okay? So I know you can't read this. You're probably on a small, I'm going through each one step by step. But what I do want to show here is that a term sheet shouldn't be 20 pages. It should be 1, 2, would you even say 3 Biola pages max. These things.
Yeah, not more than 3 pages.
Yeah, because otherwise you're negotiating a contract. So if we get into it, I'm going to go through even the easy stuff. Of course, your company name and where you're going to be incorporated. Mazi Mobility, I believe, is incorporated in Delaware. So a lot of African companies, when they're getting foreign investors, and this has a lot to do with what's called tax friction and that type of thing. Don't let one investor push you to incorporate somewhere. On the continent, I'm a big fan of Mauritius. I believe that foreign investors need to start maturing and making it easier also for the companies. The continent is, every year the economics agreements are getting more and more mature. So this is important. What we had also, Biola and I as well, is where to incorporate our funds. And, if you get one investor and he wants it in Delaware and another one wants it in Europe and another one wants it in, Liechtenstein or Luxembourg or whatever, we also, as fund managers, have to make a big decision about where to incorporate. So don't let somebody force you into something for 50K, okay? Because it's not worth it. For 2 million, yes. If they can convince you of where you should incorporate, really think it through, okay? And so this is a point that really seems like such a short line on this thing, and it's a really big thing to think about. Securities, obviously, we're talking about Series A preferred stock. Investment amounts, it's just a summary, again, to agree, so that you're saying, I, as the lead investor, unless I find anything that is a lie after this term sheet, I am committing to this amount for a total raise of, whatever, maybe I'm giving 100,000 out of 250,000. The valuation, this is a big discussion always. Early on, the Innovator Trust does work sessions on how to look at your valuation. So we are not getting into that in this, but what I will say is early on in the discussion, you have to agree to the math. So to the approach of how the valuation will be. In early stage, discounted cash flow, you can never use. Discounted cash flow is for companies that are very mature, that are looking for growth stage, and large amounts of money, like the 60 million that we had in Kenya. So don't wait too long in the discussion. Also put forward your valuation. Don't be afraid of that if they're going to walk away, and to have a robust conversation about it, because it has to be worth your time. And it's important in you with valuation. If somebody says it's $1 million and you think it's 4 million, you're off by quite a bit, because they need to understand also later rounds and about dilution, which we get into. So, so we're going to go through this step by step. Don't get overwhelmed.
Serena, actually, if you go back, just back to incorporation, that seemed to have raised a lot of eyebrows.
Okay.
We've gotten 3 questions on incorporation, so we might as well address it before we go too far.
Sure.
So why is where you incorporate important, and why would a VC angel investor want you to change where your company is incorporated? And what are the considerations for where, another question is, what are the considerations for where you incorporate as a founder? Why does it matter where you do it? So it really matters also where you are in the continent. It also matters for the future of your fundraising roadmap. And so one of the things we always like to ask people is, what do you see? I mean, this is really not angel. I mean, with angel investors, it really doesn't really matter where you're registered. It's really when you start to raise your seed, and you start to go to institutional investors that this conversation starts to come up. And it's really also important is, what is your fundraising roadmap? Because if you're going to be raising in the next 12 months, 18 months, and you're going to be raising bigger rounds, let's say you start out with saying, I'm raising 2 million now, but next I want to raise 20, and next I want to raise 100. It really starts to have a lot of different impact on the institutions that are investing. And so institutions really want to make sure that you're registered in a tax jurisdiction that really works for the majority. So your big investors will be who you have that conversation with. But with a lot of the companies that I've invested in, until recently, I mean, Delaware has become a very recent addition, because people have they have a very clear idea of what the roadmap will be for that. So what we've had to do with some of our companies is actually become a subsidiary of a Delaware corporation. And so we started out as a Nigerian entity. We invested in that entity. When that entity was going on to raise bigger rounds, they then registered in Delaware, because they now had a collection of international investors leading with a US investor. And so at that time they did, and we became a subsidiary of that company. So there are different ways, but I don't want you to be obsessed with the incorporation. It is something to consider and think about and get consultation depending on where you are. And I think what's exciting for me is the movement on the continent to create more tax friendly and also more incorporation friendly territories. I know Rwanda is in conversations. Zambia is having conversations across the continent. South Africa has always been, most South African companies and startups have always been registered in South Africa / Mauritius for bigger rounds. I'm looking forward to when we sort of create the Delaware of Africa, where people can also register very quickly. And Delaware, I mean, some of the reasons is the speed. You can do it all online. This is not, I mean, these are very easy to do, to register corporations. They're a lot more encouraging and supportive of startups. And I think the challenge we have on the continent is that a lot of our corporate laws and rules have some of their heritage in sort of independence and post-colonial. And some of those now we're really updating and working with governments to update the corporate rules and how to register and support startups. So I think that the change is coming. Yes, you should have these conversations, but really it depends on where you are in the journey. I wouldn't get too obsessed with this if I'm early in my journey. I would just register my company, get going, get traction. And then as you raise bigger rounds, it'll become more important where you incorporate again. Serena, I hope if you have anything to add to that.
I agreed completely. This you will, as you're looking around, and most entrepreneurs spend at least an hour reading or 2 hours. I spend about 3 or 4 hours a day reading actually about things. You'll end up influencing your algorithms, as we know, and you'll start getting fed information. I think Mauritius right now is the most robust, but it's not online. And I have high hopes for Rwanda. I think there's a lot of vision there. And so, you know, we'll see how it goes, but it's heading in the right direction. We had the same here in Greece. You know, we have so many good ideas and such great universities here. We're ranked 6th out of 140 for patents, and we're ranked 130 out of 140 for venture capital. So there's such a huge disconnect, and this has to do with policy. Okay, so let's go through step by step some of the rest of these. So other rights and matters. So here we hear the first term. We'll have standard broad-based weighted average anti-dilution. If you've never heard this before, this is one of the things I go through step by step. Okay, but it goes under this other rights and matters. Okay, I'm going to go through that, so I'm skipping that right now. First refusal and co-sale rights. What does that mean? What it means is that when you go to your next right, there's two parts of first refusal. One is if, for example, as a founder, you decide that you want to sell some of your shares just personally, not for fundraising, but selling them, you are obligated to offer them first to the shareholder who signed this term sheet. The other first right of refusal is for next round funding, which makes sense. They should know that you're fundraising and the timelines around that, because you're going to become an excellent communicator with your investor, of course, and they have the right then to be the first to invest. Now, what I want to guide you on is this first right of refusal. These timelines are the things. This is just a term sheet. When you get into the subscription document, and we'll talk about that more later. So you have this term sheet, then you have it turns into a subscription document, and then shareholders agreement. Okay, timing is important. I have seen here in this market where the investor had first right of refusal, but they didn't have, because the entrepreneur didn't have the experience to put in that they have to answer within 30 days. And they carried her on in 90 days. And if you don't have cash and you're fundraising, and that company ended up going bankrupt, which is just really, you know, bad behavior on the part of the investor, but it can happen. Also, if you're small in a big sea of what do you call it, of their attention. So if you have the 30 days, it needs to be worded so that it's 30 days, and after that, automatically it turns into a no. So they get 30 days to say yes, not 30 days to say no. That's very important, so that when the calendar runs out, it runs out and you can move on with your business. This is something that gets overlooked very, very, very often. And, you know, again, with money and things like this, if the marriage is good, it's great. But if the marriage isn't good, you always have to, you know, have the clauses in place to protect yourself. Now, the other thing I want to talk about is here where it says the company counsel drafts the documents and pays the lead investors legal fees. Now, you may look at us as VCs and think, well, you're sitting on millions, you cheap, you know, buggers. But the truth is that in VC, we get 2% of the fund amount as a management fee. So I have a tiny fund, 5 million. 5 million sounds like a lot of money, but what it means is that every year I have $100,000 to run the business on. And that means everything. That means closing deals and things like this. So I can invest more money to you, but I can't get more management fees. And that's why, you know, it's not so unreasonable that it's asked that the company pays the legal fees. Just so that you know that we're not being cheap or something like that. Looking at the board, here it says, you know, the lead investor designates one director, and, you know, the majority gets 2 more directors. This is a lot, you know, for a small investment. This isn't typically what it'll look like. So the point is just that a board will be described. Forget the specifics in this clause. And if it's small, then, you know, if it's a small investment, then you may not have, but there's a difference between voting and then just appearing. In an angel investor, you're going to want them you're going to want them on your board anyway. Otherwise, I'm not sure why you're taking their money, but just so the board and their expectations around the boards are part of the term sheet. Now, founder and employee investing. Biola had, kind of touched on this quite briefly, but so what is vesting? Vesting means that your shares that you have vest over time. So if you get 100 shares, I'm just going to make the math easy for myself, please. You in year one, you get 25 shares out of the 100, in year two, 25 more, year three, and it goes like this. And that period is called vesting. Now, for employees, it's very common. Here they say 4-year monthly vesting. So you accrue that amount every month with a 1-year cliff. What the cliff means is, up until the first year, you get nothing. And then at the first year, you get the first tranche of what's promised to you. Now, founders, you may, get upset. Hold on, I have to plug in my laptop. Why as investors do we want founders to vest? Because the truth is that if I'm investing in you, I don't want you to disappear. I want you to commit to sticking around for a certain amount of time. Now, you may be running this company because in maturing markets, like in the Mediterranean where I'm at, and on the continent, it takes a lot more time than in more mature places to raise that first round of funding. So you may already have been in the company 4 years, 3-4 years on average here in Greece. We need 4 years to just get a pre-seed amount, which is, it's not the same in the US or in Europe at all. You can get it within months there. So you may feel, I've already been in the company for 4 years, and now you're going to force me another 4 years. But the truth is we're investing in you. As Biola has been saying, it's the team. So I don't want you running off. I need you. I'm investing in you and the product, absolutely, but I need you. And so as you may feel your hands are tied, but your role can change within the company. If you feel that, I don't know, you're burning out, or that you're more suited for a different role and you'd like to hire someone in your role, all those things can be discussed. And this, again, has to do, these early stage investors, they're so important about how you build your relationship to discuss things like this. So Biola, do you want to add anything here? I know you feel very strongly about this as well.
Yes, I mean, this is really important. There was a company that I invested in, and just like Serena said, the founders had decided that they wanted to go on and do something else. And so we really had to look at hiring a new CEO and bringing in that new CEO. It's not just an employee relationship because it's still a startup. So we needed to reevaluate the founders' shares. And of course, we had to give the new CEO some shares. And so those were all conversations. They were very long conversations. Some of them were very difficult conversations. And I think one of the things that Serena has said a few times is marriage. And the way marriages work is your marriage sometimes is the correlation of its success is also correlated to how many difficult conversations you're willing to have, and how much maturity you bring to those difficult conversations. And that's the same thing here with your investors, with your co-founders, with your employees, is really how many difficult conversations are you willing to have and how much maturity you bring to that. And so we had to have these difficult conversations. We had to then reallocate shares, and we had to give the new CEO shares. And that CEO has gone on to grow the company and make the company extremely successful, while the original founders still have a stake in the company. So this is really important, but also to keep in mind that these change, and they change, but the most important thing is to continue to have the conversation with the investors and the founders. And we as investors were the ones that came in. Otherwise, people would have just said, we're out of here. We don't want to do this anymore. But as investors, we had to really at all times figure out how to preserve value for other investors, because we were on the board. And so at all times, we were not only working in our own interest, we were working in other investors' interests. And so that's why we had to do a lot of moving people in and out of the company and making sure that everyone had some shareholding so that they had skin in the game. And also, we didn't want the old founders to go out, and also they also couldn't start a competitor, and that was also in the agreements that we did. So these are, these are all conversations, they're ongoing, and just be ready. The biggest thing is communication. If you're feeling that you need to change leadership and you don't want to be the founder, you want to move to another role, or if you want to move out of the company, you need to be open to those conversations. Thank you.
So no shopping just basically means that, the investor will want this so that you don't bring other people in at this very important stage. Now, don't let this be for very long. The other good thing about the no shop for 30 days is that it kind of implies when you're going to close your business, when you're going to sign things. So this can be good for you as well. So now we get into voting rights. It's called protective provisions. So imagine I'm an investor, even as a minority shareholder, there's certain things that I'm going to want to have influence over. So obviously, change in the authorized number of shares means fundraising. Now, this is if you're foreshadowing in your due diligence when you expect the next fundraising to occur, then they shouldn't block you for that fundraising. You'll get more into this. This is we're just talking now at this point. There's other sessions you can have on how to negotiate shareholders agreements, but it's reasonable for the change of the authorized number of shares. You need to have the conversation though with this investor. If you know that you're going to raise a next amount in 12 months, you need to get in the subscription agreement or somewhere or verbally that they agree with you that this is going to happen, so that you know that you're on board right away. Because it's reasonable. I don't want to be diluted down to nothing. You could raise 20 million, and I know that we only need 10 million. The 20 million will dilute me out. So it's reasonable to have that conversation. On the other hand, if I know that you need to raise 2 million and I block you and the cash runs out, it's not good. Create security senior or pari passu to the existing preferred stock. What does that mean? Pari passu means on the same level, so equal. It's just Latin for that. What they are saying is, okay, in the next round of fundraising, the next group of people, you have to be informed if they are getting more favorable conditions that you are. So that's, of course, fair enough as well. Declare or pay any dividends. Fair enough, right? This has to do with the influence of cash flow of the company. You will get, robust conversations. If the founders are paying themselves a low salary and it gets to the end of the year and there is some cash and they'd like to, pay themselves something, a smart investor will know that you have to keep your founders motivated. I've seen here in this market and also in other nascent markets where, of course, the founders are paying themselves very little. I've seen founders being paid less than employees. And so, they do want to start getting some benefit as it goes along. And that's the relationship that you build. Early stage investors, it's just, you have to really build a good relationship with them. And you will understand, how you're building. There isn't one angel investment I've done where I haven't become friends with the people. And that's just the kind of relationships that I like to build also in my VC firm. Eventually, because it's such a long relationship, you want to be close and be able to have, it makes the tough conversations easier. Change the authorized number of directors. Okay, fair enough. That's governance. Liquidate or dissolve. And maybe I should explain why this is important for them. Sorry, sometimes I jump to conclusions, but this has to do with how decision making is. So when you change the number of directors, you can often change the efficiency of decision making. And so that's how an investor looks at this. They just want to be aware of it. I have been the VC's market here where they had so many protected provisions that they even wanted oversight to all new hires. And that was just, it was burdensome, and it created such a lag in decision making that it really created inefficiencies. But this also has to do with how you communicate with your investors ahead of time, so that you get authorization for the slot before you even start recruiting. So a lot of how you manage your investors, you can work around even bad actors, but it's a lot more work, unfortunately. So now we get into the fun, anti-dilution clauses. I don't know, Biola, do we take a little break now? Do we answer some questions? Because this is the math. If I show you the next slide, you're going to be like, what? We're going to do this math together. So
yeah, so let's do this. Let's just clean up our question board, because I know we're going to have more. So there's the question about the data room. We will answer that later. Break down the urgency of funding into, okay, how important is it to break down the urgency of the funding into realistic milestones? And then what are considered as risk factors, red flags that VCs and angel investors are experienced to spot that they will eject the proposal as not a fit for investing in. So we do go through that later, and we do have a checklist, so we could talk about that. Are investors generally interested in highly experimental type of projects, research projects? Also, how do you find them? So I want to get rid of this one so we can because I know we're going to have a lot more questions. So Victory, just to answer your question, yes, investors are generally interested in experimental / research projects, but you just have to find the right investor. One of the things we talked about earlier is what type of return do people expect on their investment? It really depends on and that's actually what the first thing I should have said is it really depends on the investor and what sector they're investing in. Someone investing in agriculture is expecting a different return than someone that is investing in fintech or SaaS. So we back consumer technology companies, and especially real sector, because we felt like people were not investing in that space. And so we work and negotiate with our investors very differently. So for me, if you bring a research project to me and it's around food technology or agri-tech, I'm very interested from a personal perspective to start, and then to see how we can nurture and get traction for that to qualify for VC. So for these type of projects, the best thing is to find subject matter experts or people in that sector that might already be interested, or that know that what they're currently doing is at the end of its life. So for example, if you look at oil companies, a lot of oil companies are investing in clean energy because they know that there is a lifespan on that type of energy, on that type of energy, and that there will be a transition to clean energy. And so that type of research, those type of projects, yes, they're very interested, but you will have to go out of your way to find them. But you find them through forums like this, you find them on LinkedIn, on Twitter, you find them by reading more about the research you're doing and finding the people in that space. That's how you find them. Serena, do you want to add to that?
Usually VCs will tell you what area they're investing in. If you send your pitch deck to, someone who's only fintech and you're in, consumer products or femtech, then obviously they're going to reject immediately. When we go through the checklist, we'll talk about, let's say we assume that the remit of the VC fund is a match, then we could talk about red flags when we go through the checklist, assuming that remit is a match. And
then, Serena, just one last question before we move on. How are classes of shares agreed upon? A company that has a Class A share and Class B shares, with the shares having different voting rights.
So that's a different stage of investment. When you start getting into a lot of different classes, you're talking about a later stage. When you're talking about Series A and B, you're talking about ordinary, preferred, and preferred. That's it. And you'll have some common stock for your employees, but basically for an investor, what they care about is their influence. So you're not at an early stage, you're not going to get an investor who's going to invest and buy common stocks and not have any influence. For a VC, an angel investor can decide on their own, what they want to do, but I can't imagine that situation either. So the complexity where you hear about preferred A, preferred B, this is for really big companies. And I think that Warren Buffett is best suited to answer that. He has great videos online. And if you have ambition to build a 100 million company, his shareholders announcements, he has his shareholders. I have listened to some of his meetings to see how he runs them, to see how he talks about them. But that's really huge. Right now, you're asking for 250,000, or maybe you're asking for 500,000. You won't get complicated shares division. But in this anti-dilution clause, there's 3 categories. So we will get into it a little bit right now.
Great. So I think we should just go ahead and then take our first break after the first math.
Okay, so in the term sheet, I had mentioned the anti-dilution clauses. Okay, so an anti-dilution protection basically is, I've invested, I'll be investor A or Series A, Viola is investor B. If I am getting a certain, if I paid a certain price per share, and then the next investor comes and Viola pays less per share, it's the anti-dilution protects me, basically. And there's 3 types of math. There's 3 types. So there's the broad-based weighted average, narrow-based weighted average, and fully ratcheted. Now, I know a lot of people, they don't like math, or they think it's complicated. I'm going to go through this step by step. And by the end of this, I really want everybody to tell me, all 100 of you that are participating, or 85, that you understand this, and you will. I honestly, I'm basically going to teach you the way I taught it to myself, which was really step by step by step. Okay, so here's the formula.
Before you start, just as you're starting
Yes.
to get the concept, a couple of people did something great last time. They started to put in thumbs up. So just as the minute you first get it, put in a thumbs up into the chat, and then let's just keep those thumbs up coming. When we see that we've had enough, we'll move on. But if we don't, we'll go through it again. So that would be really helpful. Thank you, guys.
Yeah, because I really, really want you to understand this. This is very important. Okay, and these are from here forward is I'm getting into the clauses that can trip you up. Okay, so let's go through the definitions of the formula, right? So CP2 is the Series A conversion price in effect immediately after the new issue. Okay, I'm going to go through this step by step, don't worry. CP1 is the Series A conversion price in effect immediately prior to the new issue. Okay, we'll get into, you'll understand this. A is the number of ordinary shares outstanding immediately prior to new issue. So including also ordinary shares, outstanding preference shares, which could be employee shares, but not CDs, so not convertible debt. Okay, so that's what A is. B is the aggregate investment in the new round of financing divided by CP1. Okay, really trust me, you're going to get this by the end of it, I promise. And C is the number of shares of stock issued in the new round. Okay, so let's go through an example. Okay, so the company raises 5 million Series A financing at a conversion price of $1. That's the basis for our calculations. Okay, so what this post Series A investment basically looks like is that in this scenario, you have a total of 25 million shares, right? So CP1, you see the one right there, conversion price is $1. The total amount of shares, they're buying 5 million shares. It's $5 million at $1 a share gives them 5 million shares. And so the 5 million over the 25 million total is how you get to the 20% total that they own. Okay, so we're starting from the basics, the easy, and then we build to the more complicated. And I'm hoping as we go through, when we get to the complicated, we get to the end, it'll be aha. So they get the 20%. So this same company goes and raises 8 million Series B financing at a conversion price of 80 cents for 10 million shares. So this is a down round, okay? So If you do it without anti-dilution, what does this look like? So we now have the 5 million shares of the first investor. In order to understand the percentage they own is over the new total amount, which was the 20 plus the 5 plus the new 10, right? So for a total of 35 million. And so that now is 14.29% instead of the 20%. Now, this Series A, he has an anti-dilution clause. And so what does that look like? Okay, yeah, so the new guy gets 28, the math, 10 million shares over the total of 35 million, gives them 28.57. So now we get into that beautiful, complicated math. And what I've done is color coordinated it. I mean, for those of you who are good at math, please don't be offended by my simplifying this. This is how I do it for myself as well. Because it's important to understand. Okay, so the CP1 is the conversion price, the original amount, right? So that's the dollar. A is the total amount of shares. So this is what changes over. So this is a broad-based anti-dilution. In broad-based, it's all outstanding shares besides the new investor equals A. Okay. B is the total amount of the new investment, and C is the total number of new shares. Okay, so that's where these numbers come from. And essentially what happens then is that you get the total number of shares, the 20 plus the 5, so 25 million, plus the 8 million, right? So the 8 million new investment, divided by the 25 million, again, total number of shares, plus C, which is the new amount of shares, 10 million. And what happens then, so that's 33 divided by 35. And this is the new diluted share amount of 94 cents, 0.9429 cents. And when you stick that back in, the 5 million divided by the 0.9429 is that you now have 5.3 million shares instead of the 5 million that they previously had. And this is basically just how the anti-dilution calculation works. Now, where did this calculation come from? I have not researched that. This is a commonly accepted anti-dilution calculation. There are others, but essentially a broad-based anti-dilution calculation looks some form of this, okay? And so I want you to feel comfortable with the terminology, with the math, so that if you see a new formula, and this formula needs to be put into the subscription agreement, so that you're both agreeing on the math, of course. And so now we go into a narrow-based anti-dilution, okay? And I'm gonna summarize all these at the end. Okay, let's just do the math. So the CP1 remains the same, which is the $1. Well, maybe I should ask now, how's everybody feeling about this?
We have a question here. Please explain 25 million. Is it total value of company? And then, but then there are some that we have a couple of thumbs up. We need more thumbs up, guys, if this is making sense.
Yes, yes.
We only have 3 thumbs up, so
okay.
It looks like maybe we go back one more slide.
Okay. So the 25 is the total amount of shares as converted to common shares. So if you recall from the previous, in the original post-A series investment, there were 20 million shares, and the Series A investor bought in 5 million shares. So that's where the 25 million, that's the total number of shares that the original shareholders have prior to the Series B investment. Does that clear it up for you?
Can you please thumbs up the person that did the questions? That 25 million now makes sense. Perfect. Yes. Thank you.
Okay, great. How are we doing on thumbs up? People are either sleeping or they're shy.
We need more thumbs up.
Yeah.
Okay, we are okay. It's looking good. It's looking good. We're getting better. Guys,
Okay,
keep the thumbs up coming. Let us know that this is making sense. Good stuff. Okay. It's looking
okay,
good.
good. Because it's really important. I want
It's
to.
looking good. Yes.
Okay, good. So now we get to the narrow-based anti-dilution. It's the same formula. What changes here, so we have the $1. What changes here now is instead of the 20 million, it's only the 5 million. It's been narrowed down to just the Series A's amount of shares. And the rest remains the same, okay. B remains the same, the $8 million. C remains the same, the 10 million shares. And what this narrow basing does is it changes the math, right? So instead of 0.9429 cents, it's now 0.8667 cents. So by narrowing it down, they're securing more of a price. Okay, so and then what happens is that this secures for them the 16.13%. And now I'm gonna summarize the changes into one table. Okay, so don't worry about that. And so really the difference between broad-based and narrow-based is just that instead of the ordinary and the Series A original investor, it's now just the Series A investor. Pretty simple, right? Even though the formula looks so daunting. Can we get another round of thumbs up? This should be
more thumbs up, guys. You can even write it in. Some people haven't been able to find the button, so they've been writing it in.
okay,
So,
great. Okay.
Okay, I see. Yes, more. We got more. So yes, we're good. I mean, there's a
Okay.
lot of even double thumbs up. So yes, we're doing well.
All right.
There's a lot of people understand the concept, so this is good.
Okay, great. Okay, so fully ratcheted is the easiest math basically, because what they do is they're allowed to then just have the same share price. Okay, and so that their amount goes up, obviously. Now I want to compare, right? So this is what matters. I want to compare this and understand, and then Biola and I will discuss why would we do this as investors, and what would we consider sort of, the type of conversation that you can have. So without dilution, this is the shareholding that would occur with fully ratcheted. What this means is that the ordinary shareholders, they lose 1.97%. It's the most beneficial fully ratcheted to the Series A. He goes up 2.95%, and the Series B investor goes down 0.98%. So this is the fully ratcheted. So this is the most, let's say, damage that can be done.
Mm-hmm.
The difference with broad-based anti-dilution, right? So that's the smallest amount of price change, is that the founders will lose basically 0.5%, and the investors will lose 0.25%. So this isn't too bad, right? But still protects the original investor. And then in narrow-based, we get into, that the founders lose 1.23%, and the Series B lose 0.5%, a little over 0.5%. So now let's talk about the pros and cons. Anti-dilution clauses, why would I ask as an investor for an anti-dilution clause? If I'm not so sure that you have a handle on your cash flow, if I think that we're going to end up needing to raise investment money sooner rather than later, I would put this in to want to protect myself, because I don't want to overthink decisions. The reason for some of these clauses is because it's protection. So instead of, risk, you just put in a clause and say, okay, fine. Let's say I'm right. This is how I'll try to protect myself. Fully ratcheted, how will the Series B investor, in this example, I'm Series A and Biola's Series B, so I get to put the pressure on Biola to answer. I mean, how would you look at this kind of a clause if you're the Series B investor?
So as a Series B investor, for me, I'm coming in because this is a de-risked company. I'm looking at the best shareholding, and also because I'm thinking of the exit. I know this company we're prepping this company either for, a couple of more rounds of funding, and I want to make sure that I understand my position. just to give you guys an example, one of the things that we did early on as early stage investors, when we first started investing, this is before safes were very popular, we did convertible notes. And when those notes were converted, the Series A investor actually, because we didn't have we just converted them and they were interested, we ended up losing quite a bit of value as early stage investors. So this really for the Series B, they're also trying to protect themselves in case other investors are coming in and larger investors are coming in. So everybody's just trying to make sure that they protect their investment and their investors, because once again, investors take money from other people. So that's sort of how I would look at this is, if we have to go and raise more money, how do I also protect my shareholding so that I end up with enough that I'm not diluted and I can actually walk away with a decent return for my investors. So everyone's looking out for them and their investors.
So I think the conversation that can take place, let's say if everyone gets to the table and there's some, because whether or not it's fully ratcheted or broad-based or narrow-based has been decided on the term sheet, and Series B has no influence on that. But what can be done in negotiation with the Series B is that they're offered the same anti-dilution protection, and that can make them feel better about the initial ones.
That's actually the best thing to do. Right.
And so anti-dilution again is always if you're doing fantastic, this is a non-issue for you. You don't have to worry about it. But it is important to know the difference between the full and the narrow and the fully ratcheted, because as an investor, even if you're doing well, this anti-dilution clause remains for the lifetime of the company. And so it's just seen as a risk. And so that's the difference if you're negotiating with entrepreneurs or you're negotiating with bankers, investors who are bankers. They will look a lot more at the numbers. And it's just a fact that the larger your investor, the more of a finance profile the investor will most likely have. And so these conversations will come up. And whatever you sign early becomes important later, but we're looking at your success. We're going to assume that you're going to be successful. And again, so I just want you to be aware of this, and when it comes up, that you can feel like you just have to remember rather than that you're learning it from the beginning. I don't know if have I fried anybody's brain, or how's everybody feeling?
Actually, the feedback is really good. Everybody really seems to
great.
And then people really seem to really get it. There's a question here on, would the clause stipulate which formula is being used to protect the investor? Most of the times, yes. But everyone seems, even people that say, look, this is normally not my sort of thing, they seem to be getting it. And we have
right.
lots of really positive feedback. This is one of the best breakdowns I've seen. Thank you.
I'm happy about that. It's important to know and understand. So the term sheet will hold anti-dilution. If you want to show the investors, you can ask for the formula that will be put into the subscription agreement. You may not see the formula on the term sheet, but why not? Ask for it if you want to, but have it verbally agreed to at least. You can have it named at least, that you will use broad-based anti-dilution or narrow-based anti-dilution, because then the formula will be easier to discuss, because there are absolutely industry standards around this formula. Any other questions, or is it a good idea to take a break?
Yes, we can also do some questions and clean up and then do a break.
Okay.
So someone said, yes, I think we've answered this, that yes, it would be stipulated. And even if it's not written out, you can ask and make sure that you all have an agreement. And other investors will ask you which formula you're using. So as new investors come in, they'll like to know that. Does VC/angel investors sign NDA for research projects, proposals? Like Airbnb, they had an innovative idea. How do they protect their idea if submitting to a few investors? I know that you have, you go into this a little bit more, and that's sort of the cookie recipe Serena talks about. So I'll hand this over to her.
Look, even with Airbnb, they already had two others, right? There was couchsurfing.com, which by the way doesn't exist, right? I don't think. And then Craigslist was the other one, which has a rather notorious risky profile, but there were already others in the space. Now, this cookie recipe, the thing that makes you different, so whether it's an algorithm or whether it's a supplier that's different, your value proposition is what you're selling on. So if you're, what I understood from the question is that you're really at the research level, so you're not launching yet. I don't sign NDAs. They're very difficult to enforce. You should be trusting people that are across from you. You have emails, you have proof that you've communicated with these people. Non-disclosure is implied. You can go ahead, you can try to use NDAs. I believe that post-term sheet is a really good time to sign one. But if you have research, what are you showing them? You should not be showing them the formula. You should be showing them the result of the formula, or philosophically what you're trying to achieve. There is trust that is needed. And so the whole thing is earning trust should be both ways. I understand in the really early stages how of the idea, but this is, you've got to earn trust. So you can sign an NDA with somebody that you don't, that's just a high net worth individual, but don't, pick. You have to decide. Be discreet. This is discretion, of who you're going to decide to go into business with.
Yeah, and do due diligence on people. I think that you need to be very careful about telling people to sign NDAs, because it also could just, one of the things about signing an NDA, it comes into someone's mailbox, other things come in. The reality of your NDAs are very rarely priorities for investors, unless it's unless it's, it has to be so out of this world. So if you're, for someone to say, okay, I'll sign an NDA, like, they also have to know about your research. They have to know that you've been working in the, for people to really be moved to sign an NDA, it's a lot. It's just not a good, most investors don't believe it's a good use of time. But they will sign it if it's almost sort of, if it's a courtship that you guys have been back and forth, and they've also done some due diligence on you. In ecosystems, the people already know who people are. So this is why this is so important to connect with founders on this platform, so that you can ask them about different investors and say, hey, have you heard of this investor? Are they good people? So do your due diligence on people. NDAs could actually be a roadblock for people. So you don't want to do that as well. You want to manage when and how you sign an NDA, especially since you're not really, with a pitch deck, you're not giving people anything. Really, what you're trying to do is tell them about the problem you're solving. You're not giving them your source code. You're not giving them your algorithm. You're not giving them the brain of what does it. So I wouldn't get too hung up on an NDA, unless what you're doing is super, NASA type of projects.
But even NASA has high level, million-foot level. So I look at NDAs two ways. One, if I'm signing privately as an angel investor, I may be more, but the minute you give me a legal document, I have to legally review it. And I have then legal obligations. So if, as in my VC firm, I'm obligated to send it to a lawyer, and that's time and money. And, you want two years non-disclosure, and then I am, because I'm talking to so many entrepreneurs, I'm going to have to, in order for it to make sense, I'm going to have to get super specific. Because if you tell me, I can't talk to anybody in the non-traditional bed renting space, it's so broad that I won't sign it. If you're, but I sign NDAs as a consultant when I go to work for certain companies, because they're giving me very sensitive information. But even that, I have to be careful, because if they say non-compete, well, if I'm an expert in telecom, what do you mean? I'm not going to work for another telecom company for a year. That's not, that's not possible. So NDAs are super tricky. So liquidation preference. Often people think immediately just bankruptcy, but that's not true. A liquidation event is essentially when your shares are going to somebody else. So it's a majority sale of the company or a merger. Yes, in some cases bankruptcy, but usually bankruptcy, it becomes a non-issue around money. So I want to talk about, there's two types of liquidation of preference. Non-participating liquidation preference, where the investor has to choose, and a participating liquidation preference, which is liquidation and shares. And again, I'm going to get into the math, so you're going to understand this very, very well. So here's the scenario. Shareholder A invested 20 million for 50% of the company, and then the company sells in year 3 for 60 million. They have a clause that says participating, remember, participating liquidation of 2x. So what does that mean on the math? So you've sold your company, you're the founders, you have 50% of the shares, and you're looking at 60 million. This looks pretty good, right? After 3 years. So what happens in a 2x liquidation participating? It means that they get 2 times of their investment. So that's 40 million. In participating, it means they get 2x plus their shares, which means you take out the 40 million of their 2x and you have 20 million left, and they get 50% of that, which is 10 million. Okay, so what that means is they get 50 million. And the founders get 50%, they get that 10 million. Now, I'm sure a lot of you are shocked, right? Obviously, when you get into a lot, when you're selling,
the actual expression is ouch.
Yes, ouch.
That has come through.
Yes, and I'm sure there's things that you're not allowed to type that people are thinking. Because I have seen this. I mean, most of my career has been on the side of the entrepreneurs. I have worked in 3 VCs, but the 2 of them were really founder friendly. I mean, we really went on the journeys with them. We would have never done this, but this happens. And I want you to know this. Now look at the next, which is non-participating liquidation of 2x. Okay, what does that look like? So that's the 20 million times 2, or 40 million, or the shares, which is 50% of the 60 million, which is 30 million. Okay. So obviously they're going to take the 2x, right? The 40 million. So that means that the founders get 20 million, which is still less than what you would intuitively feel of 50% of the 60 million, right? So this liquidation preference is important. Now, obviously you don't want a liquidation preference of 2x on this market where I'm at, the early, where the banks had all the venture capital money. And again, bankers tend to be more on the finance side. They were all getting 2x. And what happens is that your exit then for the founders to see something has to be just really huge. A 1x liquidation, we'll look into it later, but it does mean that in this example, so for the 20 million, let's say it's 5 years down the time, and you're like, I'm not so sure, how it's going. And you get a buyer, right? Let's say a buyout for 25 million. It's not, you won't get 50% of that. With 1x liquidation, they get their 20 million back first. Now, why would investors want to do that? Because they feel it sort of secures their initial investment. And as we've been discussing, the VC has a fiduciary, fancy word for financial responsibility to the money, to the people they take their money from. And so this is a protection clause. Now, if I were rich enough to have a VC with no one else involved, I wouldn't have this in there. I'm all for sharing the risk. And if I can build a good relationship with you as an entrepreneur, we can look at how to do this. But when you have, what makes me worried about the trend for larger funds of taking money from pension funds and things like this is that you can understand how they really want to protect that kind of money. I don't want to get into a philosophical discussion as to whether or not pension funds should be in high risk investments, but never mind. But a high net worth individual, okay, if you get a high net worth individual that comes in, he wants a 2x, participating liquidation, you have to understand the math. Do the math to understand what exit do I have to target to make this worth my while. Okay, so anyway, let's get into the dividends. And I'm going to get into some other scenarios just for you to be able to understand the math so that you can, when you sit down at the table with them, with investors, I want you to feel confident that you understand what you're signing up for. Okay, this is the most important part.
And Serena, I think that what's important for people to understand is that remember that by the time you're taking this type of investment and that by the time you're at this level, you're really, time is of the essence. And so it's really important for you to sort of think about these things now and think about how to respond to them, how to review them, because time becomes, I mean, time is not on your side. You have to make decisions quickly. You're building a decent sized organization at this time. And you need that cash flow to be able to get to the net, you need that cash flow either to sort of do what you need to do for your next part of the world, or because you're on a tight time to get the deal done. And so, and to get the people that are either, acquiring or liquidating your company, they also need you to work fast. And so you're really under a lot of pressure. And so this is why it's so, and so you'll be surprised when these things come up. And remember, some of these contracts you signed 5 years ago, and they're now coming up now. And so that's why it's really important to keep this in the back of your mind as you're signing this, because you also have a responsibility to yourself and to your team.
Yes, you're the one. This is going to affect also the employees that you've motivated with employee shares as well. So you're fighting for them as well. So the goal here is, a 1x non-participating liquidation preference or none at all. I think I don't know the standard actually on the continent here. You can't get less than 1x. I don't think in Europe you can get less than 1x. But you never know till you try, right? So I think we're feeling good with that, right? So thumbs up, everybody.
Okay, more thumbs up, guys, so we can move on to the next concept. Okay, allow me to share a thought. Allow me to share a thought. This is the heart of entrepreneurship, the nitty-gritty part. Let us make a tool for communicating this to all people who learn and teach entrepreneurship in the school level. Can you see income sources and digitize it? Junior achievement, entrepreneurship. Okay, so this is just this is a comment for the group, but we're seeing more thumbs up. So this seems, you can move forward.
Okay. So now we're going to get into dividends. Often what you think of as dividends is sort of when a company is large and you're owning shares from the stock market or something, and then the board decides to pay dividends. In a term sheet, it's different because it's a fixed value or a percentage of the share's original price to be paid periodically to shareholders regardless of the earnings. Okay. Or the profitability of the company. And in that sense, then it acts a little bit like a loan, if you want to say that.
Yeah.
What it does for an investor, and if we were sitting all privately together, I would put up the financial spreadsheet, the business model of the VC to show you that dividends being paid out over time helps to achieve the IRR that we're pushing for. So dividends helps us to be able to meet numbers, and 6%, we'll get into a math example. So non-cumulative dividends means that they do not accrue on the balance sheet. And that's important, right? Cumulative dividends means that they do accrue on the balance sheet and they must be paid. You're legally obligated to pay them, okay? So the goal is a 6% non-cumulative dividends annually with board approval. This is the kind of clause that you want to see. 6, obviously less, but 6%, you have to look at the cost of money, right? So interest savings accounts in the US is around 3%, 6%, it's fair, it's reasonable. I know here in Greece, the price on interest rates on credit cards are around 10, 12, 15%. So I've seen dividend percentages higher here. Personally, my business partner and I, we won't go over the 6% because we love entrepreneurs. But okay, so let's get into a sample scenario again that will put the dividends in and also show them how the math matters before and after. Okay, so the scenario is that you have 6% cumulative dividends agreed to, 2x participating. We already know that participating is ugly. We prefer non-participating, but I've made the most ugly scenario possible. and you've invested 20 million for 50%, and we're doing again the sale on year 3 of 60 million. So the dividend that's owned is the 20 million times 6% times 3 years. So 3.6 million in this scenario, we're assuming that it hasn't been paid, that it's been accruing on the balance sheets, is a liability that is owed to the investor. Okay, so now how does this get paid? There's a few ways. The buyer could decide that he wants to, that he needs to pay it off. If you can negotiate that, that's the best for you and the investors, right? On a 60 million sale, 3.6 million liability on the balance sheet is a hard nut to swallow, because we're not talking about enough. If it were 100 million for them, 3.6 million, okay, fine, we'll pay for it. Or we will agree to pay the shareholder out over time, quarterly or something like that. So the negotiation would be then between the person who holds this 3.6 million and the new buyer. That's not always the easiest, because when an investor wants to exit, he wants to exit. And if I'm a VC, I can't wait anymore, because we have the life fund of our fund. It's 10 years. So I might not be able to wait, even if I want to be reasonable. So here's 2 different maths, okay, for you to look at. In this one, the 3.6 million is paid first. Okay, so the sales price is 60 million. The dividend is paid 3.6 million, leaving the balance of 56.4 million, right? Then we take out the liquidation, which we knew at 2x participating is the 40 million. And that leaves us the 16.4 million. Okay, which you have a right, because it's participating, to 50% of the 8.2 million, which means me as the investor, I get 51.8 million out of the 60 million. How does that sound as an entrepreneur? Does that sound fantastic? So
I don't see responses. I want to see responses. Last time the response came quick.
Yeah, I mean, maybe they've passed out on the side of fallen out of their chair.
Should we send an ambulance to people?
I mean,
okay, they're frightening. It's frightening, yes.
It's
they
frightening.
definitely passed out.
And so this is, do you understand why I really, really want you to understand this math? And I know that as an entrepreneur, you have to understand so many things, but do not leave this to the accountants or the finance people or the lawyers. You've got to understand this yourself. You are negotiating, you are the best to protect yourself, okay? So now we're gonna pay the so now we're gonna pay the 3.6 million after all of the other clauses. So, sorry, yeah, 8.2 million for the founder. Following this,
I'm sorry, Serena, this is another thing. So a lot of times when you hear that someone sold their company for 60 million, but they're still either looking for a job or working, a lot of times by the time, you sort of do this math, 60 million doesn't sound like a lot. And so a lot of times when people ask us, why didn't we sell, when I talk about my old company, when we got the offer from Amazon, at that time we had raised 100 million and Amazon was only offering 120. And even though, of course, I wasn't privy to the terms, I believe that the reason they couldn't sell at that time was that actually they probably would have walked away with nothing. The founders would have walked away with nothing based on some of the term sheets that they had signed on that journey to raising that 100 million. So, just to give you guys a sense, when people say, oh, this person sold their company for 60 million looks different once the numbers come in. Yes. And
this is also, again, your initial investors. You should have a good relationship with them. This is something that you can negotiate as you go along. It becomes you need someone with you in that boardroom that's helping you along. So this is why the way the first investors' terms are set up, if you can be in the same boat together, then you're both rowing in the same direction as much as possible. So the 3.6 million paid after. We've got the 60 million, the liquidation is paid out, the 40 million. So that leaves 20 million divided by 50-50, that leaves 10 million. Now, this 3.6 million has to come, because the new buyers aren't going to pay it, has to come out of the founders 10 million that they had. And then this totals 53.6 million. And the founders only get 6.4 million. So even you think it's the same numbers, but where you pay the 3.6 million matters for the math. Something as simple as that. So it's really, it's important. I have, most of the time, I encourage entrepreneurs that when they get to the subscription agreement to do math examples. I put math examples in the subscription agreement and in the shareholders agreement so that we have all legally agreed to what this means. And so I'll have scenarios in there. And what this means is also opens up the door to negotiate minimums. So minimum sales or minimum return for the founder, just like for liquidation. All these types of things can be negotiated. And many people don't know they can be negotiated. And that's sort of the difficulty of being a first-time entrepreneur, and why having advisors who've done this before are helpful. So are we all good here? I'm sure you're going to negotiate great term sheets, and this will never happen to you. So now that you know, shall we move on? What do you think?
Yeah, I think so. I think based on the interaction and the feedback, I think people get it.
Okay.
Yeah.
And I've put the worst case scenario. Okay, so I apologize for that. I don't want it doom and gloom. I just want to make sure that you're protected. So here's another, this tag along, drag along. If you go to Investopedia, what you're going to see is that in the event of an offer, a tag along means that if you get an offer to sell your shares as a founder, that they have a legal right to tag along if they want to. Regardless of their shareholding percentage. And this is something that protects minority shareholders. So it's pretty fair. Now, what a drag along, I'm not a big fan of drag along clauses, because what it says is in the event that you find, so if an investor comes to 51%, and by the time that you get larger investments, I know we're talking about early stage now, but you have to think about it, because these clauses do not fall void in the future. Is that if a shareholder finds a buyer, they can drag you along, which means they can force you to sell. And that's where it can become bad. So of course, I've got a math example for you. Let's say we do the 20 million investment, 50%. It's year 9 or 10 of the fund, and this matters. So Viola and I have been talking to you about how a fund itself functions and the pressures that are on the fund itself. They have to liquidate what they have. So at year 9 or 10 of the fund, if they're offered 25 million, that fund will take it. And it doesn't matter the growth, doesn't matter because they're essentially tied to have to take it. Okay. And what this means to you that is, is that they'll get, let's say it's 1x in this example, 1x liquidation, they get their 20 million back plus 50% of the 5 million or 22.5 million from the 25. So one of your goals can be to kind of, and again, that's not for the term sheet, but in the subscription document, you can absolutely discuss minimum sales amounts or how they look at this type of thing. So, and that's where then you secure your rights around these types of clauses. We have here, are there any questions? So I prefer tag along to drag along.
Yeah, no questions. I think this concept is, people pretty much understand this.
Yeah.
Tag-along always feels much more friendly and, much more collegial, while drag-along is, it's everybody's sort of, and everybody has their own responsibilities at that time. So it's really also important to understand where the VC is in their cycle as well.
And so why, for drag along, imagine you're a new buyer. When you reach a certain size, people don't want the old management around. They want to try to create a new, especially in a buyout. They want to take control of the culture of the company. Now, In some cases, if you have such a big personality, like we remember Apple had fired Steve Jobs and then the shares went down and then they brought him back because his personality was so big that the shareholders, they thought they wanted him out in order to have control, but he was in fact so important. So an investor can look at it different ways or the new buyer may look at it in different ways about how they want to see the old management. If there could be a situation where they want to take over and they say, okay, we want the old management out, basically. So we have marked here as a break, but we just took one. I don't know. What do you think?
No, I think we're doing well. We wanted to see if there were going to be a lot of questions, but since there seems to be a lot of clarity, I think we should keep going. And then what we can then do at the end is have more time for Q&A. So please. So guys, please don't forget to continue to type your questions into the Q&A. And then remember, the chat is for our interactivity. And I love some of the emojis you guys have been putting up. So keep them coming.
Okay.
Someone did ask, how can we know what stage fund cycle of a prospective investor is? I think you could ask them, like, tell us more about your fund. You know, how many investments have you done to date? Where are you guys? And it's not like, where are you in your cycle? It's a very like casual conversation of saying, we want to also know more about you. Tell us more about you, your fund, you know. You could even say like, what is sort of the profile of your LPs, you know, so that's how you get to that and you start to understand where they are.
And especially after a term sheet, you absolutely have a right, or
Yes.
during the discussion of the term sheet, you absolutely have a right to ask these types of questions. Now, nothing beats desktop research. Usually, you know, especially if a fund has a fund 2, they will say, you know, fund 1 closed. And a VC will usually announce the closing of their fund, and then you know to count 10 years. So you can find out a lot from desktop research.
And you could even ask, is this coming from your fund 1 or your fund 2? You can ask that question. I mean,
Yep. So you are interviewing them as much as they're interviewing you. And I know when you're asking for money that it sounds, you know, yeah, people get funny with money, but it's a mutual interview. And if you're good at what you do, we want you as bad as you want us.
Yeah.
So the post-term sheet process. Now, I realize that in the pre-term sheet, I kind of skipped a little bit. They're going to do desktop research. Okay, we kind of mentioned that everything should be, you know, as much as you can put links and sources. That's good. So now we're at the post-term sheet, right? What happens now? What can you expect to happen? Definitely there'll be an on-site visit of some sort, depending on the amounts. If you're raising 50K, you know, no, or they may have come during whatever. But if you're talking about, you know, up to $1 million, somebody's going to come on site and interview sort of the key staff. It's at this point, they will want to do a code review and also review kind of the manufacturing process. And this now is when we get into the cookie recipe type thing, right? So I used to be a coder as an investor. If I do due diligence on the code and I see that it's documented very well, that means that the code is ready to have, you know, you're going to be hiring more people. It's going to be ready to expand. And you, as whoever the CTO is ready to bring on other people. If that code is a mess, I know as an investor that means it's going to take time to straighten it out. The onboarding process is going to cost time, and time is money. And especially for small amounts, this is just, you know, it shortens your runway. Runway is a term meaning, you know, how long will your cash take you? And so if your code, you're raising the valuation, you're raising the confidence. It's all about increasing confidence with your investors. So this type of thing, your manufacturing process, if you come in, if you are a manufacturer, is everything labeled well? Can I see that do you have good onboarding processes for new employees that show me, oh, okay, so you've thought it through, you can scale fast, you have it on your mind. Do the employees walking around kind of know what your milestones are that are needed? So an on-site is, you know, people getting along, how are they feeling, things like this. Then you move to a subscription agreement. And the subscription agreement is basically the sales contract of the issuance of new shares. Okay. It's different from the shareholders agreement. It carries less inside, but carries the term sheet with a little bit more depth. The shareholders agreement gets into a lot of the governance documents of the company. So it's a big faster, but the subscription agreement, again, also shouldn't be super long because you want them basically to sign and send the money. And the subscription agreement then will hold the final things that need to be worked out in the shareholders agreement. So now, what should you share when? We talked about the cookie recipe. The actual cookie recipe you should never give away. So when somebody wants to do a code review, please make it guided. Please make it a guided code review. Somebody should be able to look around, but you've got to protect certain aspects of it where you think, okay, this is my algorithm. This is the unique thing. Viola calls it the brain. I call it the cookie recipe. Whatever that is, you have to protect it. And it may be something as simple as a process. I was incredibly impressed in Kenya with M-Farm, with their onboarding process of new farmers. It was just so insanely efficient. And I was just, there as an advisor. And so I advised them. I was like, it's very impressive, but, unless you really trust somebody, don't share that because they can repeat that kind of thing. But what you can do is, so if you have a very efficient process that's better than the competition, is that you can prove it to them with numbers that, hey, most people do service delivery in 2 months, and we've managed to do service delivery in 10 days. Without showing them how you do that service delivery in 10 days, you can prove it though. Hey, order stuff from me, you will get it in 10 days. You'll see, you can do log files, and you can kind of prove it, figure out how to prove what you're saying is true without showing the cookie recipe part. And there's
Serena, just a quick note. Sorry about this, just housekeeping. Please put your questions in Q&A. I will not read the chat for questions. The chat is for reactions and for LinkedIn's. So please put your questions in Q&A. Thank you. I see a lot of questions popping up in chat. Because we're working with multiple screens, it's just easier if it's in Q&A and we make sure we answer all questions. If it's in chat, it gets lost very quickly. Thank you. Sorry about that. Sorry.
No, let's make it easy for Viola. She's got the Star Trek stuff going on. Okay, so now we get into digital data room. There are many providers of digital data rooms. I like DocSend. It's super easy. And basically what it is, if you've used Google Drive, or even on your computer, it's just basically a filing sharing. But what makes a difference is that you can control every aspect of it. You can control who sees what file. You can even give it I've shared files where I give a termination date so that if they haven't looked in the next 7 days, forget it. You can make it broad so that anybody with a link just has to, when I do fundraising, of course, I want the pitch deck to be seen by as many people as possible. So if they have the link, but they have to put their email address in order to go ahead and look at it. So at least I can follow up and know who's been looking. And so the file system is important. If you set up a digital data room, I promise you all of the effort is going to be worth it. And to be honest, in getting ready for due diligence, you're creating management tools that you will continue to use. It's rarely a waste of time. And I know that it's always house on fire with startups. You can get somebody to help you with this, an admin, and have them focus on this, because you're going to get a checklist of documents that they need to put into the digital data room, and assign certain tasks to other people. But we'll get into some of the specifics a little bit later. But this is what a digital data room looks like. My favorite part of a digital data room is that I can see who came to view the documents and which slides they like the best, or which part of the document they like the best. So here, I know that this guy spent his most time looking at the strategy slide, and that tells me something. I had a different investor who spent a lot of time. I had gotten into specifics about my deal flow, and which was a mistake. Even I make mistakes this late stage. Too much specific about deal flow, and all the time for this investor was spent on deal flow, which I talked to him about later on. But when we had the follow-up conversation, I knew exactly which deal in the deal flow he was interested in, and so I could understand his profile. So this is very interesting. I'm sure we can agree. So what goes in the digital data room? I think I talked about it. There's know your customer. When you get to the point of signing documents, it's a lot easier. The functionalities of digital data rooms are such that you can get online signatures. There's something KYC, know your customer. They're going to have to fill out information. You're going to have to gather it, and you're going to have to, store it somehow. And basically, when they're the ones uploading it, it makes it a lot easier for you in signing documents. It's in there. And of course, who sees what and for how long. So it also elevates you as a startup that you're doing cutting edge kind of things. I would say that out of all the the pitches I get, maybe, I don't know, 2% use digital data rooms, but I think that this trend is going to change a lot more, and it's just really useful. I don't have lots of information about all the competitors and all this kind of stuff. It is a cost. There's some that are free, maybe for 30 days. So if you're going to do a push, you can sign up for 30 days and copy paste over and have somebody else, because I know costs are a big deal for startups. Okay, so I'm going to take a deep breath.
I mean, for digital data rooms, Google Drive is very useful and very easy to use. I think if you have Google Suite, it's free. So you just have to pay for that, which a lot of people have. But also too, it's worth as long as it's capped, I think it's worth it. But I also know that if you've gone to quite a number of accelerators, they also offer this as part of an accelerator package. So it's always easy to look at. But there's nothing, data rooms, especially well-organized data rooms, easy to read data rooms, they're literally like the elixir of this industry.
And so functionality becomes the key and the difference of them. I like Google Drive, except that it doesn't let you control. Of course you can control who's coming, but the functionality about that is a bit limited for my taste.
It is.
And for me, I want to know who's looking at my documents.
Mm-hmm.
So if I send something to somebody and they say, yeah, I looked at it, I now know if they've actually looked at it and how long they spend on it. So, if they spend 30 seconds on it, I know that my follow-up time is a waste of time. If someone has spent 4 or 5, actually pitch deck is usually not looked at for more than 3 minutes, 3.5 is the average. Then you understand, because you know who's worth chasing down. So there's some other, insights that I like from the more advanced ones. So anyway, but yes, there's, Google Drive, there's things out there that you can afford for sure. So this checklist, I'm taking a deep breath because I know how long this checklist is and you don't. So this is why I'm taking a deep breath. I have the checklist on here and we'll go through it. And I've marked also when you give it as far as pre-term sheet or, at term sheet, post-term sheet. And this is kind of, you should have an Excel spreadsheet with this checklist on it and assign who's going to be doing what. And this is what comprises the contents of your digital data room. Now, most VCs will have their own additional checklists. This is just indicative, okay? So let's start with the business side. Of course, you'll have the long form pitch deck. That's pre-term sheet. You'll have a 1-pager. That's kind of an industry trend now. That's pre-term sheet. A board pack and board minutes is post-term sheet. So I want to talk about board minutes for a minute. Many startups don't bother having formal management meetings. Board is what happens after you get an investor, but you should have really monthly management meetings that talk about the KPIs that you're tracking, that talk about your runway, your use of cash, you know, whether you're on target or not, for yourself, first and foremost, for you to take a moment, and if it's every week or if it's a month, your weekly report should then fold into a monthly report. And if I'm doing due diligence and I see that already for 12 months, you're having these types of things, then I know that you're ready to run a board meeting, right? And you as a manager, you know, life's not going to get easier. You're going to be able to hire more people, but what you have to have oversight on doesn't change. So the sooner you put those tools in place and turn them into, you know, digestible information, the better. So this is what I have under the business checklist. And Biola, please, at any moment, jump in and add to this, because I know you like board minutes too as an angel investor.
I like board minutes. I like board meetings. One of my favorite early stage investments, and as an angel investor, is a company that is so meticulous about board meetings, and they put a board in place very early on, and we meet quarterly, even if it's just for an hour, and they put their minutes in. And this really helped them when they were raising their Series A. Investors were able to go in, look and see that there was really real governance, and that the CEO was accountable to the board. And that made them, that just gave people so much ease. And I think that it's important to set up a board, even very early on. It could be very small. It doesn't have to be elaborate, and you can have 1 hour meetings, you know, maybe twice a year to start. But really start to think about your board and who you want on your board, and start to do that quite early.
And so often people think about a board as having voting rights. I had the great honor of working for Jerry Ryunge. I don't know if there's any Kenyans on this call, but I worked for Wananchi, which is the product Zuku, and she started this company. So the 60 million we raised was started by a female, Jerry Ryunge, and she started her next company. And she had an advisory board from day one. And you would think she, you know, her company had 160 million in investment. Why would she need an advisory board? Because she has the experience to know that the structure of having that board meeting, of having to fill it out, is so incredibly useful. And she had some pretty heavy hitters on that advisory board, and we gave her hell. I was the least heavy hitter. I was on the friend side, you know, but she had bankers on there. She had other heavy hitters on there, and because she was serious from day one. So this is advisory board. No, they don't have a legal right to influence you. They have no voting rights, but it's still a board, and it gives you practice to do it. Even if your 3 investors are your uncle and your brother and your mom, you can have a management meeting as a way to start getting into the practice of it if you don't feel comfortable. Okay, so financials. The financial model itself, and I'm going to talk about the financial model specifically later on. Cash flow, an overview. This talks about what the term I've been using, runway. So how long is the cash that you're having now going to last? The use of funds, and we're going to get into more detail on use of funds, so I won't do it here. Those are all pre-term sheet things that should go in the digital data room. Management accounts. So again, you have a term sheet, and now they want to see if you're lying. Kind of, I mean, that's basically it, right? It's about integrity. So you can give them, you can decide yourself how much detail. Sometimes you just do a screenshot of current accounts so they know the cash runway is there. You know, if you want to give more details, I mean, for the early stage that you're doing, usually not, but it will, you know, you'll see what they ask for and the detail they ask for, and the amount of trust that you've built up and what level of detail you want to give to them. The bank balance itself, okay, you can just do a screenshot. The management accounts could be just monthly sort of cash balance. So it doesn't have to be as detailed. There's ways to negotiate the level of detail that you give without giving away that's, you know, I don't know, that you, I don't know, but any loans or anything like that also they need to know about. So external financing, there's some things for the pre-term sheet. So if if you've received any grants or any type of, angel investment or, friends and family investment, they're going to want to know about that ahead of time. If you've received grants, that kind of, due diligence proof needs to be in there. For the post-term sheet, for funding that you're trying to raise, like if you're going after something, I consider that kind of sensitive information. I would do that post-term sheet. And Biola, I know that you and I will discuss a lot on the use of funds and financial model later. So fundraising, the existing cap table, they want to know, how many shares are owned by which parties. But you're not going to give away the telephone number yet of these people and exactly who they are. Me personally, as an angel investor, I want to know personally who the other person is in the room, because if we're going to have chemistry, or if we completely disagree, it could be a disaster. But there's some things that are post-term sheet that are post, like, no, I'm seriously to invest, and I want to know now. Grant funding, again, it has to do with the sensitivity. If it's already occurred, share it. If it's in the process of occurring, I would say wait till the post-term sheet. The legal folder, all of your stickers and all of your stamps, your company stamps, and all of the things that prove that you're incorporated, you should have a scanned proof of. The articles of association that are signed that exist right now should be in there as well. What I've noticed is that when you work in big companies, I've been a signatory of big companies, you initial every single page. So the articles of association, if it's the one that's been signed and agreed to, should have, I'm looking for the initials on the corner of every page, not that it's the Word document that's been uploaded, because I don't know if that's the one that's been agreed to. Yeah. So make sure it's the signed version. The shareholders agreement is post-term sheet. You can talk about it, but actually to review the document, don't you dare give that pre-term sheet. That's post-term sheet. Don't lie about anything that's in there, because if you lie to me, I get to get out of the term sheet, or I get to change the valuation, or you can just mess everything up. It's okay to say, I prefer to talk about that at a later time. If you don't want to answer something and you're feeling pressured, it's okay to say, let's talk about that at a later time. A lot of people have a hard time saying no to investors, but no, stand your ground. You can do it in a very polite way. Most Africans I know are have an incredibly charming way to say no. So that's a gift that I haven't learned yet. But so insurance policies, post-term sheet, but those, if you have the costs, they're going to be in your financial model, right? Yeah. Now, why do I, as an investor, want to look at the insurance policies? I want to make sure, for example, I just did a 3-year project with an aviation company. I want to know that they have enough insurance to cover in case of a crash. So there's certain insurance policies that are related to a company's business that are very important to know, because it can be a huge financial liability. And unfortunately, we did have an airplane crash. I worked for a flight test company that was testing new aviation equipment. It's very high risk. And thank God the insurances. Unfortunately, we lost a very, very good colleague. But all the legal lawsuits that naturally fall from something like that could have bankrupted us. So that's why insurance policies will want to be looked at. Now, if it's your, so a lot of, sometimes, and again, this is more later stage stuff, but just so that you know, if you are the heart and soul of the company and you were to somehow disappear the next day, let's say for illness, or whatever, I have to know, I need, well, it's going to be in case of death. There's no nice way to say it, but there is a first man insurance policy sometimes that people will get on you, sort of life insurance. I think that's much later. I don't know if that comes up so much on the continent, but we had that sort of standard.
It doesn't come up so much it hasn't come up so much, but actually I have had colleagues, angel investors, who invested twice in a company, and then the founder just died in his sleep, and that was it. The investment and the company basically died with him. So that's sort of the key man risk that, yeah. So we have the key man insurance. And that was something because it was there was angels, but it was a syndicated angel group, and so they had invested quite a bit, but they did not have key man insurance on this particular founder. I mean, the founder was young; there was really no indication. But this is also brought into question: should people request that? So that's a discussion people are having, and I think that increasingly you'll see this on the continent.
And so how, as a founder, should you negotiate this? To me, if I'm a founder and the insurance policy is a significant amount, this changes your use of funds. So you need more cash. You should ask them, well, then, you have to invest more cash. Find that money for me because I have my use of funds already. I can't just find that money from somewhere. So, if it's a requirement, you can, negotiate further then as far as how this is going to be carried. And again, for us in the VC, it's easier for us to deploy more capital than for us to pay it out of our management fees or anything like that. So we wouldn't mind deploying a little extra capital for something that we feel is that important. Would you agree, Biola?
I totally agree. I mean, I think that this is key, and it's coming up more and more. So I think that it's a good conversation, and totally agree with you.
So then the final, there's two things there comes the NDAs that we had talked about. So the options, the fact that we saw in the term sheet that at a high level, you're saying, okay, we're going to have employee share options. And then here for the post-term sheet would be actual share option documents that have been signed with employees. What happened here in Greece was that the VCs put in as a requirement, because now we get into employee share options, which from a different angle. If an ecosystem, a nascent ecosystem really wants to grow, you've got to build the next generation of angel investors. And it can't just be the founders. It's got to be the employees. In Austin, Texas was the second highest funded city in the US when I was working in VC. When Dell Computing, most of you probably know it, IPO'd, there were 27 Dellionaires. And little Austin had so much angel investment money running around. It's why South by Southwest blew up, into this huge kind of thing. And angel investors from employees and not just founders, it's the next generation. And it builds a local wealth that's so important. So I am a big fan of looking and making sure that these option plans have actually been signed and are actually there and not just theoretical.
I also agree. I mean, I think that one of the things for us is not only do we look at female founders and co-founders, we also look at companies. And for us, what's important is that if there's female senior management, that they're also part of the employee share option scheme. And this is really important because exactly for what Serena said, if we want to start to plant the seed for future investors, we have to do it now. And so if an employee helps grow your company, helps build your company, and you IPO or you sell, it's nice for them to also be part of that dividend so that they can go on to invest in more. And that's how you really build, and that's how you build a sustainable ecosystem. So I think as part of why we're here today is not only to think about our own business, but also to think about the future of businesses on the continent. So this is really, and it just also frees employees to do more research, to do more things when employees are able to sort of be part of this, and then they can think bigger, and then they also go on to be founders. And that's the ecosystem we want to be creating, this cyclical opportunity for Africans.
Yes, and so when I, just to give a couple of examples, when you're fundraising, if all the money is from another country, you have to spend so much time explaining the economics of the country. When and the options, if you're stuck in traffic, like I did angel investing in a couple of Nairobi startups because I understood. I mean, the founder just said 3 seconds. I was like, yep, because I lived there. I knew it. I was like, I get the problem. Yep, for sure. Yeah. If you're outside of the country spending so much time trying, it's frustrating as a founder to have to explain the country. On the other side, if you have an immature local market investment market, they they don't understand how to invest. So you have to explain investing to them. So in this nascent, in this early stage, which I love all the process of this beginning stuff. I'm not complaining. There's the give and the take. The investor understands investing, but doesn't understand your geographic location. And he's probably going to take his earnings out of the place that you're trying to build. And then a local investor may not understand investing and have terms that you just can't, they don't know how to help you grow. And all of this is maturing, but I'll give a funny example about Amsterdam. When I first went there, we had Americans at that time were not so famous for understanding geography. I'm not sure it's better, but and we were raising 200 million, and we had on-site due diligence, and the insurance provider was saying, because the Netherlands is below sea level, this is how this country is. It always has been historically. The dams, I mean, this is, and so the insurance broker, we were on the phone with him, and he was like, "You're under sea level. What do you mean? We can't cover you for insurance. You're underwater." And because he wasn't from there, because it was foreign investors, it was just so incredibly frustrating. And, I've had so many conversations with foreign investors into Africa, just trying to explain Africa, and different things about it, where you're just like, can you please just get on an airplane and come here so I can explain to you some things, beyond even just a week of staying there. So yeah, that's, just some of the funny things that go on. So NDAs I have here, sorry, I got distracted with the story, but NDAs here, this is going to be which NDAs you have other people signed. I want to know how many people you have under NDA. And this is just sort of due diligence in general. I don't, the standard company NDA is what I want to look for, to look at the liability around it. So IP, intellectual property. Some of this is your cookie recipe, but not all of it. IP has to do with what you can legally protect as yours. So your trademarks, we had actually one of our investors in the Netherlands thought that they could rebrand us to the American brands, and they hadn't bothered looking at whether or not those names and things were available in Europe. And somebody bought up, in a very clever move, bought up all their branding names. So I want to know that, whatever brand you're showing me in the PowerPoint presentation, that you have the legal right to use it. So for your trademarks, any patents that you have already secured, those are pre-term sheets. Now a patent report, you don't have to do all of these, okay? But I'm just putting it on the checklist. A patent report is often a third party. For those of you who are saying, we're in research and development, things like this, if you hadn't secured a patent, then a third party who will say, there's 6 items that are patentable, and it's an independent third party, so I'm not seeing it. I'm not looking at your cookie recipe. They have, it's their reputation that they keep their mouth shut. This is what they do full time. And so they would write a report, and that would add value. But that's a very kind of complex and rare occurring type thing. So registered design, pre-term sheets, copyrights, pre-term sheet, technology itself. Now technology, what do I mean by technology? Obviously we talked about checking your code, that's one thing. But for example, if you're a cloud service, we have a lot of software now on the cloud, I want to know which cloud provider you're using. And if it's a 2-year, what are the financial terms and things like this? Because if you have a discount and it's creating a pricing advantage for you, and that discount runs out in a year, then that means your financials are going to change in a year. And so I want to understand how long these types of technology costs are secured in order to do a risk analysis on the financial model. So that's what goes into this. And some of these would be pre-term sheets. So if it's sort of the standard contract with something that I can find online, no problem. But if it's something that you've negotiated, then it's going to be in your financial model, and you don't want to share, because sometimes, the best negotiators have been entrepreneurs because they kind of find a way to hustle really good prices or things like this, right? Because nobody has money. And so that's post-term sheet then. Anything to add, Viola?
No, I mean, that was pretty, I mean, I think all of these things, you can decide when to put it in, but there are things you should be ready to share, especially post-term sheet. But some of these things will come up before you sign the final term sheet. And this is a great checklist to work with. Once again, it's not everything, but it is a good checklist to work with.
We still have a bunch more to go. So, so for the team, they will ask the key player documents. Yes, you as a CEO, you are going to have an employment contract. You have to have one. And in fact, it can be important as a way for you to protect yourself, to say that you have a 3-year term or a 2-year term, and what those are and what your job responsibilities are. Especially if you're going to be less than a majority shareholder, your employment contract should make it very clear what you're allowed to decide on. So if you end up being a minority shareholder, but you have a clear employment contract in which it says, okay, we sign a business plan once a year, and as long as we're sticking to it, I'm allowed to do what's, as long as I'm meeting whatever targets, I can do what I want. That type of thing is very important to secure. But here, for as an investor, some key player documents are their CVs. There has sometimes been fraud around whether or not somebody actually has a diploma. If you want to stick it into the digital data room, copies of your diploma, all this kind of stuff just brings peace of mind. The founders agreement, I'm a big fan of the founders agreement. Why? Because you get 3 founders. A lot of companies in the early stage fall apart because even though you agree to shareholding, you don't have a founders agreement, which is essentially kind of like a shareholders agreement amongst yourselves. So this agrees to things like, we do want to do fundraising. Yeah, I mean, I could talk an hour about a good founders agreement, but on the vision of the company. I have worked with a Greek company here where some of the founders who were not operationally involved were completely against getting loans and things like these. And it just tied the hands of the poor founder who was in the company. And he's like, you're not giving me a chance. You're not letting me fundraise. Neither are you letting me get a loan. How do you expect me to do this? And so that founders agreement, and of course that creates conflict, right? So then as an investor coming in, understanding what that founders agreement looks like, if it's pretty solid, and of course also with due diligence, I'm going to see how well you guys speak to each other. If one is just talking over the other, if you guys are really getting along, and things like this, it's important. So the actual contracts that you have signed, not pre-term sheet, post-term sheet, you say you have them, look into it afterwards, just tell the truth. And then hiring would be, for me, if, for example, you need to hire some kind of a specialist and it's key to your next milestones. If you have CVs of a couple people in there that you say, hey, we're recruiting these guys. Once I get the funding, I'm going to be able to close with them. That becomes then due diligence for me that I can, that just gives me more confidence. So then in the product folder.
Just quickly,
yes.
on this, I did want to add especially around founders agreement. Founders agreement becomes really, really key, especially because we're human and human beings have disagreements. And literally the last, there's 2 companies now that I've had to go through this, in which they actually had to buy out one of the founders. 2 of the founders had to buy out one of the founder because the founder just had other life issues that came up. So this wasn't even a disagreement; it was just a life change, and she had to move. And it was one of those things where it wasn't possible to continue to do things, and we had to go back to the founders agreement. And there were quite a number of things that were not agreed in the founders agreement. So almost sort of even transfer, even though all intellectual property belonged to the company, there wasn't a proper outline of how that will be transferred, and also even database transfers, all these different things. And it always seems, I mean, especially when everyone's getting along, it always seems like a minor detail. And actually, I've asked quite a number of companies and they don't have a founder's agreement. So we've actually had to ask them to go back and develop a founder's agreement. And sometimes actually going back to do a founder's agreement is much more problematic because you didn't do it and agree to it up front. But I've seen so many cases where if you don't have a founder's agreement today, please go and have a founder's agreement. It is so important. And then with contracts, I've actually seen where this was part of the data room from the beginning. And sometimes that's because people have developed a data room either for a prior round of funding, and maybe they're doing a bridge round. And since they've given you access to the data room, it's really easy sometimes to just see the contracts, especially contracts. You don't have to have all the details in them, but especially if you've told me you have this client on board, which we have found in the past that people said, look, we have a contract with the state. The government is our biggest client, and they weren't able to produce that contract. In some cases, we were able to find out from people in the government that they do have a contract, but that their contracting process just takes long, even though they've made payments to them. And then sometimes we found that the extent of the contract had maybe been exaggerated. So as quickly as you can sort of make sure that people understand what the limitations are, what the size of your contract is. And if you're working with a government, for example, a lot of African governments are very slow when it comes to contracting because of their legal process. It's really also important to point that out. So just two things I remembered from experience that I wanted to share here.
And don't forget redacting. There's software that allows you to redact. So for most part, we're going to look at the signature page. But if there's parts in there that you feel are just, don't want to, you can redact. It's an easy tool on Adobe Acrobat, and some digital data rooms have redacting options built into it. So, there's ways to do things. So getting into the product demo should go in there. Even a short film of the team, whatever, a film of the product itself. There's the technology deck and the product roadmap. Now, I have this as pre and post term sheet because, again, it comes down to the sensitivity of something. When I was in Austin and we were investing VC-wise, the product roadmap, if you're in an incredibly competitive environment, the feature that you're about to release, and if you're going to release a feature that's really important and it's going to increase sales, that is hugely sensitive information. So the product roadmap, you're going to decide how sensitive it is. Now, the roadmap could be as vague as version 1, version 2, version 3, or it could be as detailed as here we're going to have a big group of APIs delivered, here we're going to have and just talk about functionalities. So some of it is pre-term sheet and some of it is post term sheet. And then the technology deck as well. Of course, we've all seen, the icons for technology maps, let's say, but the depth of that, and as far as how they're actually connected, can become sensitive as well. Biola and I have worked in telecoms, and most of telecoms has to do with these connection points, and depending on where you're at, you get much different performance, where you store your data compared to where your customers are. All of this kind of stuff can be very sensitive. So then this is the last section of stuff. I told you this was a big slide. So the commercial, your customers, specifically post-term sheet, if you have a log file, like if you have consumer products, you can show log files of the total number outside of the database that produces that. But the actual customers themselves, if it's 1 or 2 really big customers, again, you have to be careful about it. Some of these can be really post-term sheet as far as details. And then sales pipeline can be the same thing. Letters of intent, some pre and some post. So the ones that have been signed, pre-term sheet if you want, and then the others that are in the process of being signed or negotiated, post-term sheet. That's my advice. Invoices specifically. So again, this is early stage. So, the depth of due diligence will be a little bit less. But if you're telling me that you have really high growth rate of customers, okay, I'll get a log file that shows that. And then at some point, I just want to see some of the invoices, probably just to, do a spot check on that. All marketing materials should be a pre-term sheet. Your budget, I say post-term sheet, and why? Because obviously pre-term sheet in your use of funds, you're going to say, I'm going to spend, I don't know, 150,000 on or 10,000 or whatever. But the marketing budget, as far as, specifics, can also be a little bit of the cookie recipe. So I'm going to go to these events. I'm able to get a cost per click of this amount. Things like that. Some of the marketing budget can also reveal sort of cookie recipe type things, let's say. The competition, you need to have a very robust, if I get a nice slide, it's one thing, but if you've written up something, or if you've downloaded a lot of information about the competition, you make my life easier as an investor to look at them, right? And in larger companies, you have somebody whose whole job it is to stay up on the competition, on pricing, on features, on how they're mentioned on websites, things like this, sentiment analysis. So the competition remains very important all the time through the life of a company. And then market size reports, we talked about the TAM, SAM, SUM type things. If you put them in there and it's a 90-page report and there's only 2 paragraphs that are important, please put a cover sheet on top of that says, please note page whatever, and you can go in and use tools to highlight those. Don't give me a 95-page report when actually the reference, to prove in your financial model is, 1 paragraph. So just think about making it easier and easier and easier. It's not exhaustive. I think if you have this, I think you're in a pretty good way. Have I left out anything major, Viola? I'm not sure.
No, I mean, I think that this is, I mean, if you do this, you're done. You don't have to do anything. I think that anytime you can put in testimonies from people into your data room, so testimonies from either former investors, so that people can actually understand who your investors are, and then also testimonies from current investors. And also if you can put testimonies from customers. Customers are always, who you want to see. We want to see what your customers are saying about you. And those are very simple. Literally, you can ask people to even just do a voice note on their phone. You can ask them to do a video on their video is always better. Do a video on their phone and put it into your customer folder.
Let's talk about the internal preparation. When you get past the term sheet and now you're getting the investors to come in, make sure that
Karina, just so that we just quickly, if you can go back to the last slide, there was a question, just some clarity there. So yes, pre-term sheet and post-term sheet. So that is what these, that is what the P is pre, the T is post. And so some of them you have P or T, so that means that they could happen at any time. Serena, just clarify for them. I just want to get the question right.
When I went through them, I tried to give an example of what part of like the technology deck would be pre and what would be like post. So sort of a high level schematic that doesn't give away too much detail. It could be pre-term, and then post-term sheet if they want to. Now I'm thinking specifically in telecoms investment, because you'd want to know really details like what is your connection rate or what is your drop rate on certain things, and then that's post.
No, I think they actually just want a clarification on the ones you have where you have P and T. I think that's
yes. So there will be some items that would be shared pre-term sheet, and then more depth post-term sheet.
So where you have the T, you're saying T is post, P is pre. Yeah,
correct. And then yes, exactly.
So if you have P and T, it could be either or, just different levels of it. I think they just got confused on the P or the T key, but we should add a key to this later.
Okay, I'll do that.
Yeah. All right. Otherwise, thank you guys. Otherwise, this was great. Thank you again, Serena. I'll let you go on. I wanted to get rid of that question quickly.
Yes, of course. So Internal preparation. If I show up online for on site for due diligence and your team doesn't know that in the next 2 months you're giving a next release of the product, it's a problem. So I'm coming there. We want to see that that your team is aligned, that they understand what their next deliverables are. Basically the mood. And for me, to be honestly, I really look closely at the respect with which founders treat their employees. This is very important to me. If you're gonna motivate, you've got to be able to handle stress and to help a team feel comfortable and relaxed. This is leadership. And in a big company with lots of money, if you get a bad leader, it's important, but it can be kind of diluted out by other managers being good, even if there's one bad one, or higher up the rank there's a bad one. But in such a small team, leadership is just absolutely critical. And so I will look at, I think respect, being able to create a good mood is very important. So, is your team aligned? So that means that you're communicating with them. Do they know what's going on? Again, the level of detail is different. They may not have to know that you're raising 500,000, but they do need to know that you're talking to investors. They do need to know that the key kind of milestones that you're communicating to the investors, that's part of their targets. And this is less about strategy than why wouldn't they know? I mean, they're coming there every day to do work. So why wouldn't they know what they're supposed to deliver in the next 3 months, the next 6 months? With larger investments, we had practice sessions. With the 60 million, you can imagine the types of practice sessions we had with investors. If you get workers who are nervous, have a practice session with them. Don't stress them out. If it's stressful for you, imagine for them. So bring in a friendly one first, an outsider, and then bring in somebody else so that they can be relaxed and they can have their best foot forward. So I think that covers basically the first 3 bullet points. Before I get into actually the financial model, the team. So the other thing I look at is team. I worked with a company here. These guys had known each other for 20 years. They had played football, American soccer, but football together. So I knew that they knew how to fight. These guys knew how to fight, walk off the field and be buddies. And that gave me a lot of confidence as an angel investor that they know how to discuss, that they have respect for each other, that they're gonna keep going on anyway. And I think that chemistry is a lot of what's being looked for. Would you agree, Viola? Well,
I do agree. And I mean, one of the things, I just saw something someone sent me that I would like to, I'll share in the chat. And it's a link from Jason Kalanis, an investor as well, just talking about his mistakes. One of the things that happened to me recently was there was this amazing team that came together. They were people that I knew in different domains, and they decided to come together to form this company. And I remember going back and forth with them, and I had emails upon emails upon emails, just asking, how does this work as a team? I know all 3 of you, you have great pedigree, you have great experience, you've all built great things, but how do you work together as a team? They told me everyone's roles and responsibilities. We went back and forth. There was just constantly something there. And then eventually, I mean, I did do the investment. And then literally after a year, we started having team problems. And all the things that I went back to read those emails, all the things I thought would happen, happened. But it was such a great product. It was such a great, I thought if this team worked, it would be so great. But it was, I mean, but I knew I had reservations on the team. And I told myself, this is the last time I'm going to make that mistake. The minute I have a reservation on the team, I am going to pull back. And the reservation on the team has come to bite me. So this you will find over and over. If you don't feel the alignment with the team, which means that you and your team need to be aligned. It doesn't matter who, even if you're working with external contractors. I've invested in companies where there was no staff, but a founder had people that she had worked with in different places, and they were all remote, and they were working together, and it worked. But if you are working, if the team isn't aligned and the team is not working and rowing in the same direction, I mean, investors, as an investor, you always find that this comes back to bite you. So this is really important. I can't stress how important this is. And I think to an investor, this has even just become more important to me, just watching this amazing people fall apart as a team.
So I'm going to ask you a couple questions based on what you've shared so far, because you said, okay, the founder's investment, and I find contracts prevent a lot of discussion. So if somebody has something in their mind and they kind of want to do it, but they know that a contract prevents them, it's going to, you know, stop the grumbling from getting somewhere. And that's the advantage of the founder's agreement. But looking at that last investment, do you think that you could have, you know, had an open talk with them? If you could do it again, let's say, you know, we can't look back in time, but you think you might have wanted to have a conversation? What do you think you could have done? Do you think there would have been any way, or to like hire someone in, require them to hire someone in, or have that conversation? Do you think any of those would have been options, or that you wish you would have done it?
So I wish I would have, I mean, I wish I would not have just read the emails responding to the roles and responsibilities. I would have had actually multiple conversations. So I would say, look, guys, I want to schedule 3 30-minute conversations with you guys as a team. I want to have more conversations with you as a team. So whenever we would have conversations, there was always there was a vocal voice, and then I would have had different people lead that. So really understanding how them understanding each other as a team, and not just people with expertise that bring amazing things to the partnership. The second thing is I would have asked for I did not ask to see their founders agreement. I knew they had a founders agreement because all of them had had legal background. So I knew they had one. I didn't ask for it because I knew all of them. But I would ask for that today. Like, that's not something I would ever go without seeing today. The other thing that I would do differently is the minute I started having the questions about the dynamics of the team, I would have kept on doubling down on that. And then I would have put something in the agreement that I had with them in the case of founders conflict, because the team was the biggest red flag. But they were all just so qualified. They were such stellar individuals, such stellar founders. They were all individual founders that had either had an exit. And so it really made sense that they came together to solve this big problem. But I think that whenever you're worried about a group of people coming together for a specific project, it wasn't as organic. And I think I would go back and once I knew that was the red flag, I would have dug deeper into that. But yeah, we've sorted it out because people, different people have done. One person has done an exit and the other 2 are pushing forward, and now things are back on track. But it does cause disruption. It causes delays. It's not good for a startup to not know what's happening or where it's going. And other investors did not come in right away till we sorted that out. So we were able to now go on and raise more money. But it was a challenge.
Yeah, I mean, you've done 30 angel investments, so for sure you've grown and learned yourself. I look at my own journey and I think, wow, from the beginning till now. I mean, when I invest as an angel investor, it's much more instinctual. I trust my female intuition a lot that I'm not really allowed to use in VC in some ways, right? Because I can't stick it in a box. But usually, yeah, the things have turned out, and I'm less shy now to stick my nose in the business. I've figured out. I mean, that's all the part about growing up and getting gray hair. But anyway,
and also just getting more comfortable with investing in, like today, I would never have done that investment today as a VC until they actually showed me the partners agreement. But as an angel, because I knew them, angel mentality is very different from VC mentality.
Yep, for sure.
But you get better every time. You start to know when your intuition is telling you something, it's then a problem. So you then start to double down. And really, I mean, I probably would have passed on the investment had it been today.
Yeah. Interesting story. Thank you. Okay, so we'll move on to the financial model. Most people don't like financial models. I'm putting this up. The details are absolutely irrelevant. I'm just putting up this picture because it is a financial model. And I want to tell the story about this startup that I've used. These guys gave me permission to use to show this part of the financial model because it's so old. I was approached by an entrepreneur. He was 4th generation farmer. He did not have a pitch deck. He did not have a financial model, but I knew his products and I knew how great they were. And I knew that he knew his stuff. And so when I started talking, the reason a lot of farmers or people who deal with, food things, they can't get venture capital. Finding investors is much harder, and going to a bank, forget it, absolutely forget it. So he had gone to banks. And the thing with his financial model, I don't know, most people don't know, farmers get paid in 90 to 120 days. And this is globally true. And it's a problem. And the reason he got the best of the best of the best was, as a 4th generation farmer, he paid his farmers in 30 days. So they were lining up at it. They still to this day line up at his door to give him the best of his stuff. And that's why he wins so many awards. And so the bankers didn't want to give him a loan because this aspect, they said, no, you should be waiting to pay. So, I said, you've got to go, you've got to learn how to fundraise. And adorable guy. I don't speak Greek very well at all. So we kind of Greek English, you can imagine. And so I taught him how to make a pitch deck. We made a great pitch deck. And then we started getting into the financial model. And the guy, thank God I don't speak Greek, because I'm pretty sure he was cursing me a few times through the whole process. But in the end, he loves it now. And so the way you build, the point of that is just that the way you build the financial model is going to be a tool for you. Accounting is backward looking, financial model is forward looking. And so the important part of this slide is not, and by the way, he got 250,000 from a high net worth individual, and he's doing great. The part I want you to look at is the sheets themselves and how they're made up. Okay, so in making a financial model is very complex. It can take a lot of time to look through. If you want to make it easier for an investor to look through, this color coding is good. And I'm going to tell you the groups that are in it as well. These data sheets, how you build the model itself, based on the names, the titles of them. I could jump around. I knew the investor was going to be able to jump around and find the information they needed easily and be able to go back to, when they had a question, be able to open it up and then instinctively, or not instinctively, intuitively find the data that they needed. So the high level summary, this is just P&L and all that kind of stuff. Cash flow, this is kind of the businessy finance part of things. But then in operations were things like the expense analysis, like rent and everything like that, operations as they related to the product itself, the assets that were held, sales forecasts and channels, in-store promotion, because this is sort of subject specific to, so you can have a tab if there's anything specific to your industry itself. Payroll costs and employee expenses. So payroll costs is a salary, and employee expenses then specific, like if you're going to give a telephone or things like this. And so the sheets are divided so easily that it is an investor. And then the third one was the product itself. So the costs of transportation, provisions, cost of goods sold, and gross margins are separate. And you can intuitively, as an investor, they can go and look at this. Now, if you had a tool like this, when you start using this, you can start making adjustments very quickly. And now, he is a master of this Excel sheet. And it's, he uses it as a tool. Anytime a price changes, he can go in and forward looking, see how it's going to affect him, which right now with inflation, how it is has been very useful. And also then looking at break-even things. What volume do I need to sell this at? If I change the pricing, what will it do? Very quickly and very intuitively for himself. But we built something that the investor could really go into and look at easily, because the financial model could take hours to figure out if you're not setting it up with the investor in mind. And it ends up being a very good tool as well. So this is how I advise financial models to be to be set up to make investor, due diligence much easier. Are there questions on this? Viola, do you want to add?
For me, sorry, I've been answering some questions and I didn't want my tapping the keyboard to get in the way. One of the things for me is when I'm able to look at the financial model, it just gives me a sense into the founder's brain, how they're thinking about the business, how they see the future of the business, how they're spending money, like cost efficiency. Are they, some people you'll see things and you're asking yourself, why do you have this? Why are you buying this? And also too, it gives you a sense of where they see the business going and how they see the business growing. And I think that this is really important if you're going to be investing in people's business. So I always tell people, like, yes, I look at the accounts and the management accounts, but I also want to know the future of what we're building. And then this also gives us really great metrics data to be tracking. And then you can put this in the dashboard later on so that it becomes easy and very important ways of updating your investors as well. To me, that's why you do this, but everyone has to do this. I know it's not your favorite, it might not be your favorite thing, but people are going to want this and they are going to want to see it in the data room.
Yes. Use of funds, we're getting into this now. When we look back at the presentation of Airbnb, it was pretty straightforward, right? It was the 500K, 12 months, it's going to get to 2 million in revenues. In the Mazi Mobility, they were high level. It had to do with who they were presenting to and the fact that they had such a robust digital data room that they didn't put it on the slide itself. So there's no criticism here. But what I do want to look at is if you just have a pie chart like this, okay, let's say you're just sending out a pitch deck, you're not going to invite them yet to the digital data room because you shouldn't right away, first step, right? So the way this looks like spending to me. And as an investor, it doesn't really tell me. It doesn't tell me anything. What am I getting for this? So a better use of funds would be something that looks like I'm buying something for it, not that just money is being spent. So, it's how much money am I raising and what's the runway for it, the expected runway, and what am I going to get for this? What are the major milestones that are expected to be achieved? So is it customers? I'm going to get 300 new ones. Is it going to be 330% month-on-month growth? What's the total revenue target for that expenditure? These are, I put in these milestones, don't copy paste these kind of can apply to everybody, but may not, because it is really what I want to know what I'm buying. What am I getting for this? Salary is 15%. Is it new people? Is it the same people? The technical, you can have a product roadmap. So a robust product roadmap, but at a high level, technically, what are we doing? We're doing 3 new releases. Are we getting APIs to all the major, softwares that we want to integrate? At a high level, what are the milestones that we're going to achieve with this? Because that's kind of the sexy part. That's the thing that's going to get me interested. So is 500K going to get me there? Or is it I'm just spending money on salaries? Where are we going? So I'm gonna let Viola speak on this, because I know that this is a big one for you.
Yes. I think lately we've been seeing use of funds slides that are very vague. And then when you now even dig deeper, founders people are not as forthcoming with what they're actually going to be spending money on. And I think that when you have milestones attached to it, when you have targets attached to it, it's really, really important for people to understand, what are you going to be using this money for? Are you going to be and how much runway does this give you? How long will you need this? How long will we now need to go back out and raise money? And one of the things we did when we saw this use of funds for one of the companies I was advising, I said, look, if you're going to go out and raise money now, no one wants to sort of see you come back to market in 7 months. So why don't you just do a 12-month use of funds? So let's actually raise more so that for the next 12 months, you have money and you don't have to sort of stop growth and then because also what you have to understand as a founder, fundraising takes time. It's not, you still have to continue to work, you have to continue to build, and you have to have about 3, 4, 5 meetings a day. You have to reach out to new potentials until you close that fund. And actually, until you close the fund and the money hits your account, the money's not there yet. And so it is time consuming. I've seen some founders get so exhausted by the fundraising that they actually felt like work was lacking. So you really, it's a very it's a tough balance. And so what you want to do is try to limit any sort of ambiguity very quickly. And also this gives people confidence that you know what you're spending money on. To just say, OPEX or in CapEx, people are like, well, what's that mean for me? People have duties, people have fiduciary duties, and they're custodians of capital. And so they have to really understand what you have here. So please, in as much as you can do something similar like this, you can call it targets, you can call it metrics. So people actually understand what you're going to be spending money on and why you need this money. And remember, a lot of the investors also have experience. And so I've been on investor calls where people are like, I'm a software engineer. How much are you paying a software engineer? And founders are like, oh, well, we pay this, we pay that. And there's like, nope, I know what this means. I know what this title makes. And some of your investors are founders themselves. So you really want to come prepared to answer this. And the more information you put, the more people are going to trust the information you're giving them. Thank you.
And let's talk about salaries, because there was a trend here to, oh, why are you paying so much? Well, if you want good people and people know what they're worth, you get what you pay for. Now, overpaying is bad as well, but you get what you pay for. So this gets back then into the digital data room of, hey, this person has 15 years experience. I'm not, doing learning on the job kind of stuff. These people are worth this kind of money. I have to recruit them away from something else. So this is too low isn't good. And of course too high either. But too low isn't good. You can recruit higher skilled people with employee shares, right? If they believe in this mission, you could say, hey, how did you get a 20-year person? Well, they believe in the mission, and we're doing employee shares with them. So yeah, this is.
So, Sarita, I have a question for you. I'm a freelance direct response copywriter marketer who left everything behind to pursue building my startup. My question is, as a solo founder, can I use part of my seed capital to get my shit together? For instance, I'm looking to raise $500,000 convertible note. 80% of that is getting my stuff together and paying for certain mentorship programs to improve my marketing skills, communication skills, and every skill I need to become a great CEO. 20% of that is for the MVP. Is this plausible?
I'd say you're.
I think this is a comedian, and this is a comedy writing, actually. So
I think this, no, obviously no.
Obviously, no.
But
I thought that
I don't know your sales abilities. I mean, if you came to me, I would say no, spend the money on outsourcing to the skills that you're trying to learn, sit next to the person that you've hired to do it and learn that way. So you're actually getting something rather than me paying your education. So even if it was meant in humor, there's a different way to put that money. But
I thought that was good comedy relief. I mean,
exactly.
But I do have to say that when investors see founders like this, it does actually doesn't do it does a disservice to serious entrepreneurs. And one of the things Serena said very early on is that startups are not a learn on the job place. So please go get the skills you need and then do your startup. Startups are really for the daily grind and for the day-to-day building. And they're hard. I mean, let's not sort of think that they're hard, and you can see all the things that is expected of you, that this is not something that you approach lightly. It is something that you definitely have to take very seriously, and also understand that every time you send someone a deck, it is their time. People are paying attention. And so you always want to be respectful of your time as a founder, your time as an entrepreneur, and then other people's time. So just a note. Thank you, Serena.
Yeah, and if you have people on the advisory board, if you want to recruit an advisory board, if you just send them stuff, the way that you communicate with them I always advise startups to think about what's your dream team, like your dream football team, but in startup world, who would you want to recruit on your advisory board? And the way to do that is how you respect their time. So if you send an email, say, I need advice on this, don't send me a 20-page article I'm supposed to. You can send that link as a resource, but to say, there was this trend, do you have an opinion on it? Just make it super easy and digestible for me to be able to respond, and you can slowly recruit people. But it's all about communication and definitely the respecting of time. I've been extremely frustrated where I've helped people out and then I hear nothing for 6 months, and then they get back to me with the next question, and I think, yeah, I'm not engaged anymore, especially if I'm doing pro bono stuff. It's like, come on. You ask my advice, I want to know how it went naturally, because I care. If you're asking me and you don't think I'm going to care, then how can you trust my advice? But anyway, that's something else. So let's go to the org chart. Thank you to the person who gave us comic relief there for a moment. So the org chart, sorry for the ugly colors. I prefer to see an org chart look like this, as far as, okay, when are you going to hire people? Don't just put everybody in the org chart. I want to understand what the growth of the company is going to look like over time. And what's important for you as a manager, going back to the business for the financial model as well, is if you use that as a tool and you're, for example, not generating revenues as fast as you thought, then you should use that as a tool to slow down on the hiring as well, because you're going to lower your burn rate. Don't start firing people too soon, but you have these levers as a manager that you need to understand how to use. And one of those things that will bring confidence in an investor, and even you can ask, right? So Biola and I have, maybe I shouldn't add the years experience we have together, but 45 years experience together, and senior management of large companies. So if cash flow or sales are working right, to start, to ask some advice or think, I'm thinking of doing this. I don't want you to be insecure as an entrepreneur. You have the instinct, especially if you have, you may be a first-time entrepreneur, but you may have come from a big company previously, to look at the levers and understand, okay, I'm going to slow down some of the expenditures because the sales are going right, or this channel didn't work out the way I thought, or something like this, so that we know that the levers are being used. And the org chart is one of them, especially for bringing on new people. And also, if I get a monthly management report and you told me our hiring, because a good management report talks about who you hired and who you're going to hire, and you were supposed to hire 2 people and you didn't hire them, then I wonder, but you said you needed to hire these people to achieve your targets. So what is the implication for achieving your targets? So org chart plays a huge, huge role. It's very important. It's not just a bunch of people's faces on a thing. It's humans that deliver your milestones. So that's why I put this in here. And then we've come to the end. I have no idea about our total time, but a project plan. This is a really, if you have this as well, then you're a superstar. Okay, but I'm going to put it in here, which is a project plan that shows really the time, and if you can tie the money to it, so that, okay, we said 500,000 in 12 months, but if I'm getting a monthly report and you're showing me, here was the original, and this is how we're progressing against it, and here's our cash burn rate on the bottom, then I know that you are on top of it.
Yep.
Not just a matter of saying my cash balance in the bank account is whatever. Okay, it's a matter of, I've spent this in these categories, and that's why cost accounting is important, right? To know, and therefore, my runway is this. Sales are coming in not as well, so that means this changes the runway. Even you're meeting absolutely every other target in the company. So that can be a very, very impressive addition. Excuse me. And that brings us to the end.
Perfect. 12:02. So we have come to the end of our session. Once again, Can everyone just please put a round of applause into the chat for Serena? This was amazing. We really enjoyed every bit of this. One of the things I wanted to say, you were talking about org chart, is that sometimes you'll read about companies that have gone on to raise quite a bit of money, but on the other hand, they're also laying people off or getting rid of people. It really comes into what Serena was saying about cash flow and really becoming much more cash efficient. And so sometimes you might have to ramp up as a founder, and sometimes you have to make tough decisions to ramp down and also minimize your cash flow if you're not tracking at a revenue that you would expect it to. And these are, once again, things that people like to see you do, things that people like to see in your updates. So yes, you said you're bringing in 5 more people in 6 to 12 months, but then that doesn't look possible anymore. We want to see those adjustments in your monthly reports, in your management reports when you send them. But oh, look at that. The applauses are just coming in. This was such a great session. There's a lot of thanks yous here. I've tried to answer as many of the questions in the Q&A, just typing them. Regarding financials, is there a certain amount you should be making in revenue or profit to be eligible for pre-stage funding? Once again, this is really subjective. It really depends on your sector. It depends on what type of investors you're looking at and some traction. But I think that, and angel investors will tell you what type of traction they like to see before they invest. So people do like to see some revenue. Sometimes it's just one customer. They want to see that you have one person that believes in you, that is willing to buy this product. And so Rosie, it really just depends. There's quite a bit of consideration of what's sensitive to share or not. I think we've answered this when it comes to what to share, when to share things. I think the rule of thumb is, if you believe that you and the investor are building a long-term relationship and you believe that they are going to invest in your company, feel free to share things. But once again, don't share your cookie recipe. Don't share the brain, but share as much information as you can. Can an investor use your information? Most investors worth their weight will not use your information. I mean, once again, due diligence on them, talk to other people talk to other portfolio companies. You'll get a good sense. And if people don't give you their portfolio companies, that means that they're not serious. So they should be able to give you other people that they've invested in. That's pretty much it. Someone is a beginner, you want to find advisors, find people to mentor you on this journey. It's a long journey. Find the right people and partner with them, and really make sure you're part of Innovator Trust. So follow Innovator Trust. They really give you great information on how to connect with mentors and how to connect with great people. I think we've covered risk factors. We've really covered a lot of these questions. So once again, I'm really, really proud to be part of today. Serena, thank you for bringing me along on this journey, and Innovator Trust for your commitment to really creating sustainable SMMEs on the continent, and really making sure that we give entrepreneurs the right tool when it comes to mentoring, when it comes to innovating, and when it comes to growing their companies. So thank you so much. Serena, over to you.
So, and just one last question on the advisory board as far as giving shares.
Oh, yes.
Have them sign an advisory board agreement. There's templates available online, and they should vest as well. So make them have to deliver a certain amount of time and things like this. And sometimes advisory board, I've been paid a sitting fee, but once you download a template, you'll see, which is I get paid to show up to these meetings. It can be as little as 250 up to 2,000 per quarter, depending on the size of the company. So there's different ways to compensate an advisor.
At the beginning, yes, if you want the commitment of an advisor, you should give them some shares that do vest. There's a FAST agreement online. Just type in FAST agreement, and you could just add advisory, it'll come up. But we'll also give it to Innovator Trust to put in their reference material. But yes, thank you. Thank you for catching that. I think I was reading through these too quickly, but yes.
No, I feel bad that I can't see everybody's faces. That would be nice. But I don't know if Innovator Trust wants to jump back on for a last.
Yes, for a last comment. Thank you guys for really a great day. Thank you everyone for your participation and your engagement. This was great.
I think on behalf of Innovator Trust, we just want to sincerely thank you, Serena and Viola. This has been so informative.
Thank you everyone, really, for your commitment as well. A big round of applause to you, and really for your engagement. You guys were really engaged, and really, I enjoyed today. Thank you.
Thank you.